Good morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, the Federal Reserve raised interest rates by a quarter point, defying a minority of economists who predicted a pause. In a press conference, Fed Chair Jerome Powell made it clear that the Fed is not backing down from its inflation battle and expressed confidence that the banking sector is sound. Now, around the same time, Treasury Secretary Janet Yellen was testifying before Congress about the failure of Silicon Valley Bank, and she said she has not considered, quote, blanket insurance on all U.S. bank deposits. When she made her comments, well, we saw stocks go lower. Second thing you need to know, the CEO of TikTok is set to testify before Congress today at 10 a.m. The House Energy and Commerce Committee will grill him on TikTok's relationship with its Chinese owner ByteDance and the platform's handling of user data. This hearing comes as some members of Congress push for a nationwide ban of the app. They say it poses a threat to national security. President Biden is demanding that TikTok break away from ByteDance or face the consequences. Third thing you need to know, the Securities and Exchange Commission is cracking down on Coinbase. The digital currency platform said it received a so-called Wells notice from the SEC that describes its plans to take legal action against the company. The letter hones in on several aspects of Coinbase's business, including assets on its crypto exchange, its Coinbase Earn service, and its wallet service. This comes from a probe that started back in mid-2022 prior to the collapse of FTX. Coinbase CEO said that the company is, quote, right on the law, and he remains confident in the platform. Well, the Federal Reserve hiked interest rates by a quarter point and signaled there will be just one more hike this year before a pause, perhaps, at least if you look at the dots. It comes amid the turmoil in the banking sector. Let's bring in Brandywine Global Portfolio Manager John McClain. John, yesterday, as we talked about, we saw stocks go down. We saw the bond market move as well, not just because of Jay Powell, but because of Janet Yellen as well, and the comments she made about not necessarily offering universal deposit insurance. Do you think that their comments were at odds with one another? And sort of what was your takeaway as we heard both of these folks speaking?
Yeah, I mean, I do think that they were at odds with each other. And I think that the market sold off a bit because we're a little bit concerned that, one side is not talking to the other. But I think we did learn a lot after yesterday's press conference, and that is the Fed's priority remains taming inflation, and that they believe they've got the targeted tools at their disposal to handle the banking crisis. So the Fed has this dual mandate, right, of price stability as well as unemployment. Unemployment's fine at this point, and I believe Wall Street wanted to bring in the banking crisis to the Fed's mandate, and I think we heard from Yellen that, hey, we're not backstopping all deposits at the moment. And I think it's at the moment right now. I don't think the market is comfortable with the targeted response that we've seen. I think we're going to have to do more, and that this is really probably the second or third inning of what we're going to see in terms of a banking crisis in the U.S.
If you're an investor this morning, perhaps trying not to fight the Fed, but to anticipate at least what the Fed may do in future and after future meetings as well, perhaps you're also looking at this line that Fed Chair Jay Powell had yesterday of a period of below trend growth economically. What would you be taking away from that to really kind of set your own positioning following the Fed Chair's press conference and the FOMC decision yesterday?
Yeah, I mean, this is a classic response in terms of the economy to a meaningful Fed tightening cycle here, which is we were already starting to see leading indicators showing the economy starting to trend down here. And now with the banking crisis, we're going to see the economy continue to contract and move materially lower over the intermediate time frame. So I think that, really, even if we solve the confidence issue with banks through targeted policy, banks are going to hoard capital, and that's going to be a problem for the real economy. So you need to position your portfolios to be able to deal with a slowing economy.
And what does that positioning look like, John?
Well, I mean, there's a lot of interesting things in the marketplace. I think right now equities are clearly overvalued, given what we believe to be a declining earnings environment. We also believe that Treasury yields are still attractive here. And certainly with an inverted curve, there's a temptation to allocate much more towards the front end, but duration is a bit of your friend in a declining economic environment. And actually, from our perspective, we believe high yield is the riskiest low risk thing that you can allocate to in your portfolio, with yields at 9% right now. That's pretty attractive and certainly materially higher than what we see inflation at.
One of the other comments that we got from Fed Chair Jay Powell yesterday was really regarding the banking turmoil that has ensued. Do you believe that the continued commentary that we've got from Powell, from Yellen, is enough to soothe clients of all of the banks right now, especially as they're rolling out all of the necessary backstops in order to make sure that consumers know that the banking system is safe, that businesses know that as well, and that there is not a moral hazard, perhaps, that we should be concerned about there?
No, again, I still think it's the early innings. I think the market is heavily focused on First Republic to see how that is going to eventually play out. If that bank were to get subsumed or potentially the equity gets wiped, I think that you could see additional contagion spreading to the next number of banks here. I think really what we've seen is that banking business models are impaired relative to 2 weeks ago. The cost of capital for them is going up materially. Their profitability is going down materially, and they're going to be we're going to see materially more regulation as well. So I think that we're going to see more targeted policy, and I think it's going to end up with insuring all deposits for a finite amount of time, probably a year, and with the Fed exercising a heavy hand and saying we're gonna regulate banks much more aggressively, particularly kind of the small banks, the sub $250 billion in asset banks. We're going to regulate you heavily, and it's going to be in your best interest to continue to merge.
John, you're a high yield guy, so I got to ask you a high yield question because you manage that kind of debt. You mentioned in your note to us that high yield is pricing in 10% defaults. That is 10% of all high yield defaulting. You see defaults below that, and yet what I'm hearing from you is a decent amount of pessimism. So it's interesting to me that you actually think the market is overpricing the chance or overestimating the chance of more defaults. Can you kind of explain that to us?
Sure, absolutely. It's why do you get in trouble as a high yield borrower? You get in trouble if you've got a looming maturity and you can't roll that debt. And you get in trouble if you don't have enough earnings to cover your interest expenses. And we don't see either one of those as being a material issue in the marketplace today. It's really, where is high yield as an asset class from today's starting point? Leverage is really low. Interest coverage is very high because companies borrowed aggressively in 20 and 21 at low coupons for long duration. It's like you or I getting a 30-year mortgage at 2 3/4 in 2020. The maturity wall is very light as well. So there's not a lot of maturities coming due over the next couple of years. The credit quality is drastically improved in the high yield asset class. The double Bs are north of 50% of the market. And the last time that they defaulted at north of 1% was actually in 2002. And additionally, we see higher recovery rates in the event of a default. And so the other thing that we're hearing, and it's a material positive for the asset class, is management teams are now focused on interest coverage and debt reduction. They're focused on paying down debt because their cost of capital has gone up 500 basis points over the past 15 months. So now that capital is expensive and it's much more scarce, management teams understand that they need to focus on running a clean balance sheet to be able to take advantages as the economy starts to slow.
Sort of on a related note here, Torsten Slok, chief economist over at Apollo, was out with a chart this morning that looked at capital markets effectively freezing up since SVB went under. Particularly, U.S. investment grade issuance on the far left of the screen has been pretty much non-existent since March 11th. And he talks about that the longer this lasts, the worse it will be for the broader economy. Do you agree? And how long do you think that things are going to be shut?
Yeah, they're not going to be shut long. I mean, I think if you go back and you look at the GFC, capital markets were really closed for about 6 to 9 months, which is the longest we've observed on record. During COVID, that was weak. For high yield, it was probably about 45 days. And I think what that chart brings up is an interesting point that we highlight to our clients as one of the key themes for 2023, which is that companies have an access to a variety of forms of capital that'll provide depth and breadth of funding sources for quality businesses. So if you think about below investment grade markets, pre-GFC, that was just U.S. high yield bonds. Now we have European markets, the leveraged loan market, private credit, convertible debt, and even private equity as a venue for companies to access capital in this type of environment. So we don't think that the market's going to stay closed for an extended period of time. And even if certain markets stay closed for a period of time, companies will have access to a variety of different venues of capital.
Brandywine Global Portfolio Manager John McClain. John, always a pleasure to get some of your time and insights. Thanks so much for joining us this morning. And everyone, switching gears here, TikTok is heading to the Hill. CEO Shou Chew will testify in front of a House committee later on today. Now, this as Congress weighs a bipartisan bill to ban the app nationwide. Lawmakers have accused TikTok, owned by Chinese company ByteDance, of course. They've accused them of spying on Americans and pushing propaganda. The app currently claims 150 billion users and 150 million users in the U.S. alone. And those users are loyal, of course, we do know. In a Washington Post poll, 41% of U.S. adults overall supported banning the app, but that support dropped to just 17% among daily users, 54% of whom outright oppose the ban here. Okay, so this set to begin at 10 a.m. Eastern time, and of course we're going to have some boots on the ground coverage there. But there have been so many pieces that have taken place to even get TikTok to the growth that it's seen, whether those figures are actually true or not right now, in terms of the growth that we've seen even over the past 2 years. But at the end of the day, I think there's no question about the prominence among the most valuable cohort of social media users, which is Gen Z and even younger, that TikTok has been able to attract. And this is also a geopolitical issue time and time again, every time that this comes up, whether that be during the Trump administration or now during the Biden administration.
I was squinting at our chart that had by cohort, by age, the TikTok users, because it doesn't have the youngest people on there, which is kind of weird, right? Under 18, I would think, is a pretty significant user base also of TikTok. But I guess, and although these numbers don't seem to be from TikTok, but TikTok doesn't want to emphasize those younger users because that's partially the cohort that is under scrutiny by Congress. So it seems like there are sort of two issues at play here. One, there's the issue of, is the app in and of itself a harm in some way? Is it a harm to young people? And members of Congress expected to zero in on the idea that under 16 or young users in China are subject to a different TikTok than young users in the United States. So there's that aspect. And then there is the aspect, of course, of the geopolitical part of it, and whether indeed China is using TikTok to gather intelligence on U.S. citizens, whether China is using TikTok even to spread propaganda, for example. Is it that kind of vehicle? So you have these two kind of different things at play here, and I think both of them are going to get attention during that hearing today. And
that core kind of younger user that you were talking about, that's where other social media platforms have run into issues in the past, whether that be Facebook and their subsidiaries Instagram, for instance, and how they are either serving up or the algorithm is pushing certain types of content to their users, which had come into their own level of questioning among lawmakers in Washington, D.C. But then additionally, even with YouTube has run into issues with that. And that's not necessarily considered the same type of social media platform as is a Facebook, Instagram, or TikTok. But at the same time, there is still so much focus on protecting younger users. But at the same time, I think it's also just regulators trying to wrap their heads around the astronomical growth that we've seen of TikTok, even though it seems like much of the growth that we've seen to this point, it's really already not just been done, it's been monetized. It's been so seeped in to young and just popular culture now too.
Yeah, it's true.
in the influencer economy.
Yeah, I share your skepticism over that 150 million user, but maybe. Let's talk Coinbase. Shares there are sliding in pre-market trading on news that the Securities and Exchange Commission is threatening a potential lawsuit against the largest U.S. crypto exchange. The enforcement related to alleged violations of federal securities law. That's according to a filing out on Wednesday. Federal regulators are also heading for Hollywood. Several celebrities, including Lindsay Lohan and Jake Paul, have been charged with illegally promoting cryptocurrencies. We're going to break down more of what all this means, not just for Coinbase, but for the broader crypto space coming up.
Ford is changing up its financial reporting, now splitting earnings into 3 categories: Ford Blue, Ford Model E, and Ford Pro. But as the automaker doubles down on EV production, its predicted $3 billion loss in 2023 for its electric vehicle sector is raising some concerns. Ford CFO John Lawler joins us now alongside Yahoo Finance's executive editor Brian Sozzi. John, always a pleasure to speak with you. You're down there on the floor of the New York Stock Exchange. Tell some of those traders to move to the side so we got a clear shot of you. But at the end of the day, when we think about this new reporting structure, this is something that you teased, you talked about, and really kicked off the conversation around last year this time. And so now, even as this formally goes into place, how should the investors who are watching, how should the street be evaluating these different sectors as standalones?
Yeah, well, this is really about us refounding Ford, and that's going to enable us to deliver our Ford Plus plan, right? So this is all about increasing our focus, speed, and accountability across the 3 business segments. And we'll be providing our investors transparency that they haven't had before. Transparency into how each business segment is running, really focused on the products and services we're providing the customers, how we're growing each of these business segments. And when you look at it, you think about it, the EV business was a startup buried inside Ford. And then we have our commercial business that is a gem that not many people got to see in depth. And now they'll be able to see that.
John, Brian here. Good to see you. What's the biggest challenge Ford is up against in reaching profitability in that EV business?
Well, I think it's a startup. And like all startups, as you're scaling and growing, you have losses there. For us, the key thing is going to be scaling. That's going to be a big lever for us to get there. Our 2nd and 3rd generation of vehicles where we have a clean sheet design, and then of course what we're doing with our batteries to drive efficiency and get better designs there. Now, when you think about it, we were a first mover. Last year in the US, we were number 2 in EVs. We've got 3 vehicles on the road. 60% of those customers are new to Ford, and it's giving us tremendous insight and data into what those customers need, how to scale battery production, etc., as we then move into our 2nd generation of vehicles mid-decade.
John, as we talk about the path to profitability, I mean, it is a startup, but it's a startup with Ford behind it, where you already have production lines, you already have institutional knowledge in place, et cetera, some of the barriers that a typical startup wouldn't have. So do you think then that the push to profitability, now that it's not quite as tethered to the rest of the business, does it happen more quickly?
So we have profitability and we have a margin growth to 8%, which we committed to by 2026. But you're exactly right. It's the best of both worlds. We have the manufacturing and the development knowledge of Ford behind now with Model E, that startup approach, the agile approach of developing those vehicles. So we see it as the best of both worlds, and that's going to allow us to accelerate towards profitability and deliver our commitments in 2026.
John, Brian again, how much in terms of costs will you have to take out of that legacy auto business to fund profitability in the EV business?
You know, we've been very transparent about the fact that our cost structure is not competitive. So we know that we're about $7 to $8 billion that we could take out and improve our competitiveness. And you'll see that start to take hold as we get through the rest of this year into 24 and beyond. So we're very, very focused on improving our cost structure and bringing that to the bottom line and using that to invest in both Pro and E.
Does the continued improvement of the cost structure mean that there are going to be continued headcount reconsiderations at Ford, considering the segments now that are officially rolling out their own reporting?
Well, each of the segments will approach it differently, but the most important thing that we can do to work on our costs in blue and in other areas as well, is to really focus on efficiency, getting the waste out of the system, simplification, less complexity, a lot of commonality and reuse across parts that the customers don't see. There's a lot of opportunity for us to drive those cost improvements over the next couple of years.
John, I was talking to one CFO at dinner the other night, and I asked them how they're managing through the current banking crisis, and my takeaway was it sounded like they were putting boards over their house and really battening down the hatches for a potential economic storm. What has been your approach over at Ford the past 2 weeks?
So we've planned for this year that we would have potentially a moderate recession in Europe, a minor recession here in the U.S. We said that we're going to see some price compression across the industry as we go through the year. So we're focused in on controlling the levers that we can control, really working and focusing on taking cost out and managing this environment as best we can. And so we're very focused on cost structure, because that's what you do in an environment like this. You focus on your costs, you drive productivity, and you work every lever that you can.
John, you've said that within this growth opportunity for EVs, you're excited about 2 million vehicles by 2026. Do you believe that Ford is ahead of or behind reaching that target?
I think we're right on track to reach that target. At the end of this year, we'll be able to produce at a run rate of 600,000 units. And as we've said previously, we were number 2 in the US last year in EV sales. We have 3 great products on the road today. Demand is very strong. And so we think we're right on track to meet those objectives.
John, great to catch up with you this morning. Thanks a lot for joining us. John Lawler, Ford Chief Financial Officer. Thank you. Coming up, busy times for the SEC. The agency closing in on Coinbase with the threat of enforcement action, also charging the likes of Lindsay Lohan and Jake Paul over their crypto deals. Coinbase shares down 20%. We'll have that and more movers next. Shares of Block are cratering right now, down 16% after the release of Hindenburg Research's latest scathing report. That's 2 months after the short seller's explosive allegations against Adani Group. Hindenburg Research's, what it says is a 2-year investigation into Block, concluded that the company has allegedly systematically taken advantage of the demographics it claims to be helping. And just for a little way of background here, Hindenburg Research is a short seller, comes out with short research reports, right? I had tweeted yesterday that it was coming out with its next report. Mm-hmm. That got a lot of attention. So there, this is definitely strategic here, but the allegations in this report are pretty staggering here, essentially saying that Block allows fraudulent accounts or turns a blind eye to them, right. That it allows criminals to operate pretty much unchecked on the platform, and therefore has vastly inflated the number of users it actually has. By the way, we've reached out to Block for comment on this. We have not yet gotten that comment back as of now. Yeah,
a lot of the bullets within here are absolutely eye-opening, and one of them, I believe we have the tweet, because they had started to tweet out some of the receipts that were necessary when you're publishing a report like this. And part of it was within one of the points that they made within this report, they turned some accounts into Donald Trump or into Elon Musk, were easily able to send and receive money. They ordered a Cash card under their obviously fake Donald Trump account, checking to see if Cash App's compliance would take issue. Card promptly arrived in the mail. You're taking a look at that card on the screen there. They also mentioned that within the kind of overstating of its genuine user accounts has understated its customer acquisition costs, and former employees estimated that 40 to 75% of accounts they reviewed were fake, involved in fraud, or were additional accounts tied to a single individual. So it comes back to an issue of how companies are identifying a unique user versus one user that has multiple accounts, perhaps, at the end of the day. Yeah, and also this is alleging that some of the misuse of the platform perhaps happened during COVID relief payment time, right? That the CEO, Jack Dorsey, according to this report, said users could get their payments, remittances through Cash App immediately with no bank account needed. And then states were trying to claw back allegedly fraudulent payments following that. Again, all of this is according to this report. You have to couch these carefully when you get these short reports, because Hindenburg has done research here, comes out with this report, obviously, has something it wants to achieve in making these allegations. Hindenburg does have a record of getting some of this stuff right. Adani is definitely a big example of that. But again, just to, right now, this is one source and one report and allegations. Yeah, I mean, some of the other reports that we think about as well, even in the past, Nikola and Trevor Milton, and for Hindenburg, that was a major kind of kicking off point. At least the research report that they put out was a kicking off point to the investigation into Nikola, and then the subsequent downfall from leadership at Nikola of Trevor Milton and some of the fraudulent allegations and convictions that came forward later on as well. So there is a history within Hindenburg Research in being correct about some of the reports that they do publish. So we'll see what Block has to say about this too, hopefully as they return our calls here. Yeah, I'm just looking at how Block's, Square is still the ticker, isn't it? SQ, how the stock has done. This is a stock that peaked like many of its tech and fintech peers back in 2021. Peaked a little bit earlier. Many of them peaked in like October, November. It peaked in August. August 5th was the high. It's down 66% since then, has recovered about 16% this year. So it has it has not done as well as many of the other momentum peers, if you will, for the year to date, which is interesting. Actually, I'm going to back out today's action to see if that changes at all, because it's down so much no, of course, it doesn't count today because we're not open. And started. So yes, soon. It's up 16% Seconds from now,
the year. Fact. Exactly. Exactly.
And I mean, it's been a business it's going through multiple acquisitions, whether that be Tidal, whether that be bringing in delivery elements to its own business as well. And so still one that is largely valuable for so many merchants out there, small businesses that had used the point of sale platform, and then even all the way to the Cash App platform that's been valuable as well for for peer-to-peer transactions, but just a question of how many actual peers are on there.
Yeah, that's really the question. And so again, just to update our viewers, Hindenburg Research out with this short recommendation of a block. We are out to the company for comment, and we will bring that to you if and when we do get it, if they do address these allegations. So waiting for that as we see the stock slide. In the meantime, we got the opening bell, and there indeed is Ford, who we just spoke to moments ago. The CFO, John Lawler, joining us just a few moments ago to discuss the company's new reporting structure, its new push for, or its existing push for profitability in its EV unit. So the folks from Ford down there ringing the opening bell. And our opening bell coverage on Wall Street sponsored by Tasty Trade as we take a look at the markets here as we get underway this morning. We had the big drop yesterday in stocks in the wake not just of Jay Powell raising rates, announcing that the Fed was raising rates by a quarter percentage point, but also Janet Yellen of Treasury talking about that at this moment, she hasn't had discussions, isn't considering a blanket insurance, deposit insurance on all deposits in the U.S. So after that yesterday, we're coming back here today, Brad.
Hey, yesterday took an L, but today we bounced back, kind of. Dow Jones Industrial Average, you're seeing that higher right now. Oh, there we go. We'll populate this board for you, and we'll give you a 4-day view just so you have a look at what the entirety of this week has held. Taking a look at the Dow out of the gate right now, we are higher by about 0.6%. Past 4 days, net higher by about 1.1%. Also taking a brief gander at the tech-heavy Nasdaq Composite, it is higher by about 1.3%. We'll call that this morning. Past 4 days, net positive. And the S&P 500, you're seeing that up as well by about 0.9%. Bless you right now. And also taking a look at the 11 S&P 500 sectors. We've got largely green on the screen here today. Utilities had to mess things up. It's down by about 0.4% right now, the lone laggard here. And over the course of the week, let's just see how it's been performing as well. Give you a 4-day look at that. Yeah, it's not doing well over the course of this week either. It's down by about 4.4% just over the past 4 days. But take a look at communication services. Oh yeah, past 4 days up by about 2.3% here today, adding on by about 1.5% there, leading the charge. Technology has also been an interesting sector to continue to keep an eye on. Highly urged, giving that some more attention here on the day, as we will for a hot second. It's up by about 1.4%, and the continued kind of bounce back of some of the battered tech names and semiconductors intertwined within that. A great conversation that you guys had with NVIDIA, of course, yesterday. And so just taking a brief look at the Nasdaq 100 tech-heavy average. And since I mentioned NVDA, there it is on your screen today. It's up by about 2.7%.
Yep, there it is. Thanks so much, Brad. Let's talk about Coinbase. The company's shares under pressure after it received a Wells notice from the Securities and Exchange Commission. What's a Wells notice? Well, it's basically a notice from the SEC that you might get sued or you might be under some kind of further scrutiny here. Preliminary determination is what it said to recommend an enforcement action against the crypto exchange over federal securities laws. Traditionally, if you're an investor in a company gets a Wells notice, that is not something that you want to hear. Coinbase has pressed back pretty forcefully against the SEC and has been really for quite some time now. But this is, it has to do with Coinbase itself and whether it is going to be regulated further by the SEC, whether it is its assets that it's peddling are securities, whether they're not securities. But obviously this is also important for the bigger, crypto landscape, and Coinbase has positioned this as such.
Yeah, and it's particularly taking aim at a part of their Earn, their Prime, and their wallet products here. On the wallet side, at least, of course, Coinbase is one of the larger players there, considering you can buy and sell cryptocurrencies, and then storage comes into play of those cryptocurrencies, and Coinbase has built a business around that storage as well. And so the wallet product, pretty considerable there. And then additionally on the Earn side, as it relates to staking, that's increasingly important too. It's a part of their business that they were looking to grow out even more. This has been built into their business model for Coinbase, and as well as some of the other cryptocurrencies exchanges. They had first acknowledged this in their first quarter of 2022 earnings, how their revenues would ultimately be benefited by staking. But this is essentially when someone purchases cryptocurrency and then the option to store those coins for utilization for a period of time. But the utilization of those coins that they store is basically just for the confirming of transactions, essentially, at the end of the day, verification, validation of transactions on the blockchain. So with all of that, I mean, that could be a hit to what is a budding business for Coinbase, but not a massive part of the business.
No, but it needs more business, right? Like that's the issue here for Coinbase, right? Its bread and butter business is so subject to the whims of the broader crypto market, and it has seen a drop in activity, and so has tried to bolt on some of these other services. If it can't do it, then, that's not necessarily great news.
Yeah, absolutely. Let's talk about one of the tastier of the bunch here this morning. Darden Restaurants out with a beat on the top and bottom line while also boosting its full year comparable sales forecast. Shares are only up by about 0.7% right now. Earlier pre-market, they were up by, I think I saw it up by about 2% at one point pre-market, but wow, things do change once
that's
you
really interesting here.
Once you flip the switch on that good old Mr. or Mrs. Market. At the end of the day, taking a look at some of the actuals versus the estimates there. Yeah, we took it out to 1/1000th of a penny for you, just for good measure, but ultimately that's still a beat, whichever way you slice it. Taking a look at some of the year-over-year comps there, particularly they did highlight that Olive Garden just kind of continued to put the team on its back. They saw the strongest comps there. That was up by about 12.3% in terms of the same restaurant sales there. So the tour to Italy and the endless salad and breadsticks really doing some wonders for Darden.
Yeah, it looks like maybe something that is pressuring the company is it said that costs are going to keep going up.
Yeah.
It's not seeing disinflation. Costs are going to rise by 7 to 7.5% in this fiscal year. Now, its fiscal year ends in May, but still in December, it had said it was expecting an increase of 7%. So it's increasing that range, or saying maybe it could be 0.5% higher even than estimated. So the company, while it sees comp sales rising this year 6.5 to 7%, it's seeing those cost pressures still intact, which is quite interesting.
Yeah, those cost pressures are certainly impacting the year-to-date segment profits for every business that they have. Olive Garden, Longhorn Steakhouse, Fine Dining, and the other businesses as they categorize it. All of them have slipped in terms of their segment profit. So coming back to some of those costs that you were mentioning, Julie, that's certainly compressing the margins there as well that they're able to realize.
Yes, indeed. Should be interesting to hear from some other restaurants if they're seeing similar pressures. Coming up, the CEO of TikTok is set for a grilling in Congress, and if those lawmakers one of those lawmakers happens to have a master's degree in AI. Pretty interesting. Yahoo Finance's Rochelle Akufo is going to talk to him ahead of the hearing. That's next.
TikTok CEO preparing for a grilling on Capitol Hill as he sets up to face lawmakers over a potential ban of the video sharing app. Yahoo Finance's Rochelle Akufo is on Capitol Hill with one of them now. Rochelle, take it away.
Hey, Brad, thank you so much. So yes, live here on Capitol Hill, this really highly anticipated testimony that we're expecting from the CEO. But joining me now is Representative Jay Obalnote of California. I want to thank you for joining me first. And obviously you have a very special, unique background when it comes to AI, something that's rare in Congress here. Talk about your top concerns when it comes to the AI usage of the technology and how TikTok is using that.
Well, artificial intelligence is really key to the problems that we're considering with not only TikTok, but also other social media companies. The fact is these big tech social media companies are collecting this incredible volume of data about American users. And if you have access to that data and you have access to good AI algorithms, you can use that to create eerily accurate predictions of human behavior and also use those predictions to influence future human behavior. So from a national security perspective, that would be a very dangerous tool to allow to fall in the hands of a foreign country, which is why we're having this hearing today.
So a lot of people are wondering, are there concrete examples that you've perhaps seen the CCP using this data nefariously, or is it more about the potential of what they can do with the data?
I think it's mostly about the potential and about the fact that TikTok has been very evasive when it comes to telling people exactly what data they're collecting, where that data is being stored, and how that data is used. And again, I don't think this is unique to TikTok, although TikTok has been under scrutiny and really, to be honest, has not dealt with that scrutiny very gracefully.
And I mean, as you mentioned, some other examples of other social media companies who perhaps there are also questions about what they do with the data. Is there then a concern that it seems like TikTok is being singled out when you do have sort of data brokering going on with, say, Facebook, as we saw with some of the misinformation that happened with the campaign?
Well, sure. I mean, I think that's fair, but consider the fact that we're not talking about banning Facebook, for example, because Facebook is a company where we have concerns about the way the data is being used, but they aren't national security concerns. They are privacy concerns. And we're going to be talking later this year in Congress about comprehensive federal data privacy legislation that would protect the data privacy of American users in ways that prevent that kind of bad behavior that we're concerned about. But we have a specific national security concern in the case of data that could fall into the hands of a foreign country and be used to influence American public opinion, which other countries have been caught doing this in the past. So that's the basis of the hearing today.
And so what sort of assurances would you like to hear from TikTok at this point?
Well, the Shou Chew, the president of TikTok, is going to be testifying at the hearing. He and I have had previous discussions about this. We're both software engineers, so we kind of talk on a level that's different than most members of Congress. But I'm going to have some very pointed questions for him about something called Project Texas. That's what TikTok is calling it. This is their answer to our concerns about the privacy of American user data, and a plan from them on how to protect that usage. But I have some serious technical concerns that there's really nothing that you can do if you have someone with malicious intent. There's nothing you can do from a technical perspective to prevent that from happening. So I want to ask about their source code control. I want to ask about the standards of encryption that they have on their data and some other technical details about Project Texas, because I have some skepticism that it's going to do what they claim it's going to do.
And we do have a few notes from Shou Chew's prepared testimony, especially regarding Project Texas. He says that Oracle has already begun inspecting TikTok's source code and will have unprecedented access to the related algorithms and data models, and that when the process is complete, that all protected US data will be under the protection of US law and under the control of a US-led security team. And he claims that under this structure, there is no way for the Chinese government to access it or compel it to do so. Do you think that goes far enough, though? Does that alleviate the concerns that you have?
Well, as a software engineer myself, I have some deep technical skepticism that it's going to do exactly what he says it's going to do. So my questions for him are going to revolve around, that's great, Oracle's going to review the source code. How much source code is there? Where is that source code stored? When a software engineer in China, for example, makes a change to that source code, how is that change integrated into the system? And how long between when that change is added and when it goes live to the user? How long before someone at Oracle reviews that change? Those are the kind of questions that I'm concerned about. And that's just one narrow domain of Project Texas. There are a lot of different aspects I'd like to discuss.
And so then talk about some of those aspects, because obviously that is just one part. What else would you like to question Shou about?
Well, again, some of the other technical aspects, particularly of what user data they're collecting, why they're collecting it, and how it's being stored. So one of the aspects of Project Texas is that TikTok wants to shift the storage of American user data completely within the United States, and they claim that that's a way of protecting that data. But for myself, I don't care as much where it's stored. I care who has access to it. I care if it's mirrored, if it's backed up, where do those backups occur. I want to know who's writing the server code, who's maintaining the server code. I want to know if it's possible for a software engineer with malicious intent to get inserted into Oracle's employment structure, or USDS, which is the US arm of TikTok. Those are the kind of safeguards I'm going to be asking about.
Now, as I did mention, you do have this unique position of having a graduate degree in AI. How hard is it to try and shape policy in this space when the expertise is so narrow, and you do have a lot of lawmakers who don't have a familiarity with this?
Well, I think it takes people from all different walks of life to create a functioning legislative body, and so I'm glad I'm here representing the AI community. Well, there are only 4 computer scientists in Congress currently, which I would say we're underrepresented. So I spent a lot of time educating my colleagues, about the real dangers of AI and the ways that I think it can be used to create economic conditions that look and act like monopolies in the United States. So we're going to be working on that, but I'm glad that I'm here to be able to be a resource to my colleagues, because I think that that's what it takes to create well-reasoned, intelligent law.
Now, obviously, you have a lot of TikTok creators who make their money on there, and Shou ahead of this testimony in a TikTok said that there are about 5 million businesses who rely on this, mostly small and medium businesses. You're a business person yourself. What would you tell some of these companies who are saying, look, this is my livelihood that could be impacted by a ban?
Sure, well, that's why we're being so careful and deliberate about this, because the last thing that Congress wants to do is step in and ban something that Americans use. But when there are safety implications, when there are national security implications, we have an obligation, a constitutional obligation, to step in and look at what those implications are, what the risks are, and the way that we can most appropriately solve them. So that's why we're having this hearing today. It's part of the deliberative process. We're not marking up a bill to ban TikTok today. What we're doing is asking pointed questions of TikTok and its management about the concerns that we have. And we'll see, based on those answers and some of our technical investigations, what the next steps are.
And we have seen certain countries ban TikTok, like India, for example, and we have seen some state bans as well. Is a total ban really the best option on the table? Is there perhaps a middle ground that could be found?
Well, in the long term, the solution is for the United States to adopt federal data privacy protections that apply not only to TikTok, but all of the big tech and social media companies. The ways that AI can be used to manipulate markets, to manipulate public opinions are truly alarming. And the AI has a lot of beneficial uses, don't get me wrong. I think it's going to create an inflection point where human prosperity is going to expand like never before. So it's going to be a great thing for human society, but it has these economic dangers that we as protectors of free markets have to guard against. So long term, that's what we need to do, and I know that the chairwoman of the Energy and Commerce Committee, Chair Horace Rogers, and the ranking member, Frank Pallone, and I and a bunch of other members of the committee are hard at work at legislation to do that. So that's the long-term solution. And any action with respect specifically to TikTok is just in the short term.
All right, well, I do thank you for your time this morning. I know it's a busy day for you. Representative Obernolte, thank you so much. Back to you in the studio, Brad.
All right, and thanks so much to our own Rochelle Akufo there, live on Capitol Hill, tracking all things that TikTok hearing starting at 10 a.m. Coming up, everyone, blame the Fed. We're going to speak with a strategist who says the central bank's experimental policies of the last decade directly contributed to today's banking problems. You don't want to miss this conversation.
Well, at the center of the Federal Reserve's rate hike decision is a bank crisis that grows from the Fed's own actions. During Wednesday's press conference, Jerome Powell sought to distance the broader banking system from Silicon Valley Bank.
So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record.
So basically, Powell is saying this was an idiosyncratic situation. It was the fault of the bank's management. But some others are saying, guess what? It's the Fed's fault. Marvin Barth is one of those. He's thematic markets founder, and he wrote at some length about this. And of course, this is a bigger picture, right, Marvin? That the sort of ultra low rates, quantitative easing led to the conditions that then created what happened at Silicon Valley Bank. As concisely and clearly as you can you make that case for us?
Yeah, I mean, it's important to remember that whenever an institution fails, it's due to a multitude of sources. And Chairman Powell is not wrong. There were clear risk management failures at Silicon Valley Bank. But let's remember that we're seeing significant losses across the board. This is what market concerns are about right now, is what other banks might be there. I think Silicon Valley Bank was the weak link, but the broader losses are associated with security losses from banks taking too much interest rate risk. What that means is that they took much more long-dated securities on board to their balance sheet, didn't hedge those appropriately, and they're suffering losses on those as interest rates go up. Now, interest rates go up all the time. We haven't seen them in the last decade or so, but in previous cycles we didn't see this kind of across the board losses. What was different this time? This time we had a decade of the Federal Reserve forcing banks to take more reserves on balance sheet. That's what QE was. Buy bonds in exchange for reserves. Reserves are money banks can't get rid of. They can't use, they can't give it to us. It is stuck on their balance sheet, which lowers their profitability and forces them to go take more risk. And at the same time, was telling them, you should go take more interest rate risk. You should move out the yield curve, buy longer maturity bonds. That was the express desire of the Fed. They actually said that very directly, and that's what they expected QE to do. And so these losses are absolutely directly attributable to Federal Reserve policy in the past.
And so even with that, Marvin, do you believe that on the front of long-term securities that there is more exposure that is in the system? And if so, to what comparison is it elevated among cycles past?
Okay, so I actually think that at this point, this is a tempest in the teapot. So I've just spent a moment criticizing my former colleagues at the Fed. Now let me tell you what an excellent job they've done. The term lending facility that they've created really does solve this problem. Because think about it, what's happened is most of these losses are in the bank's hold to maturity books. Those are books that are under accrual accounting, and as long as you don't have to sell them off, they actually mature at par and you take no losses whatsoever. It's only if you have to sell them when their values are depressed before they mature. And what the term lending facility does is it allows them to access liquidity if you do have depositor flight, right? So I actually think this crisis is now overblown. We've seen the weak links taken out. The rest of the banking system, while it could have suffered greater losses had they not put this term lending facility in place, they've done that. We're in a much better position. And that's why I actually think yesterday's market reaction to the Fed was completely off base, totally wrong direction.
Well, and I, it's interesting that you say this because I sort of read not only the statement, but also the commentary from Jay Powell, including the sound that we just played where he sort of laid the blame at the bank itself as sort of saying, like, guys, this is not a big deal, or at least it's not a systemic risk and there's not this bigger risk of contagion. Do you think is there still a risk of a bigger ripple effect in the wake of SVB's collapse?
Not in the U.S. Okay, so I really do think if you look at what banks did, and you can see this very clearly in the data. As the Fed pursued QE, particularly this last round of QE associated with COVID, banks did take a lot more securities on board. Banks did extend the maturity profile. You can tell that by how much they pushed onto their hold to maturity books. All of that is the sort of heart of U.S. banking problems. And as I just explained, term funding takes care of that. We don't have to worry about that at this stage. But if you think about outside the U.S., central banks all over the world were pursuing this exact same policy. But in many ways, they were, like in Europe's case, they were encouraging them to lend more. So the ECB had a specific policy that you could actually get cheaper financing from them if you went out and lent more to the non-financial sector. What kind of credit risk did they take? Those are going to be much harder to uncover. It's also worth noting that what brought down Credit Suisse, it was not interest rate risk. Yes, that probably played some role. It was really losses on poor lending decisions they made, which was about credit risk.
So how will this influence? I mean, we just saw from the Bank of England their decision today to increase their rate by about 1/4 percentage points to 4.25% now. And they gave even more comments on the health of the banking system. How does this continue to play a role in the decision making from central banks around the world?
Well, they're in a tough spot, right? So, we definitely have an inflation problem. I think economists as a whole and markets, you can see this from TIPS market pricing, really underestimated inflationary pressures in the system. They continue to do so, as we saw from the inflation report a week and a half ago, that actually there's still significant inflation pressures out there. In the UK, that's even more so than in the US, right? So one thing that will definitely worsen financial stability is if you let inflation get out of control and thus let risk premia start to creep into a broad array of financial assets. So they absolutely need to tackle that, but they also need to tackle the underlying banking issues. In the US, I think they've done it. They've used the separation principle. We're going to use regulatory forbearance and our lender of last resort facilities, but we're going to continue to go on our path to try and address inflation through higher rates. That's likely the path that European authorities are going to do. But so far, what we've seen is only that second part, not necessarily what they're going to do to support banks.
And finally, Marvin, I want to ask you about Janet Yellen, because you mentioned the stock market fell yesterday in the U.S. after Powell talk, but a lot of people were pointing the finger at Yellen, saying it was her statement that we were not going to get this blanket insurance of deposits in the U.S. that was to blame. But A, were people really expecting that that was definitely going to happen? And B, if it doesn't happen, is that a big problem?
Well, I think markets definitely started to go there, right? Markets worry about how significant the broader losses in the banking system are and what deposit flight might look like at some of these regional banks. So there was this expectation there, and that's, to your point, exactly what you saw markets reacting to yesterday. That said, again, I do think the term lending facility takes care of most of that problem. I think it's also important to remember that one of the single biggest political lobbies in the United States is actually the regional banks. They are extremely powerful in Congress. So the Treasury Secretary is wisely not saying, hey, there's a blanket guarantee, go take as much risk as you want as banks. That's an irresponsible thing to do. But she is highlighting that, in fact, she actually explicitly said, Congress, you should review what deposit insurance should be. How much risk do you want to take? How much do you want to put taxpayers' money on the line?
Marvin, really interesting conversation here. Thank you so much for joining us. Hope you come back. Marvin Barth, Thematic Markets founder. Appreciate it. And want to bring you some breaking economic news right now on the housing market. New home sales rising by 1.1% in February on a month-over-month basis to an annual pace of That looks to be a little bit lower than estimated, but we must have had a revision the prior month, and indeed we did. So the initial read on January was 670,000. It gets revised down to 633,000. That's why the month-over-month looks like a gain. So I guess it's a wash when you look at it versus estimates, Brad. But, we got existing home sales earlier in the week that came in better than estimated.
Right.
This coming in worse than estimated on an absolute basis.
Yeah.
So this goes to, I guess, the supply question that we have been discussing.
And on the supply side, for new home sales, different than, of course, some of the existing homes, when sellers are deciding to list their properties, because if they're seeing an unfavorable environment for themselves to see a greater realized gain on that home sale, then they're more likely to sit on that property if they can. But for the new homes, it's been more about, can the delivery actually be completed either on time or in expectation of what the service level agreement is to the customer or the home buyer as well at the end of the day. So keep a close eye on some of the stocks, especially within the new home sector. Companies like Lennar, companies like Toll Brothers even. Toll Brothers is up on the day by about 3% here. Also keeping an eye on KB Homes, and you can even keep an eye on XHB, which is the home builders sector, the sector ETF tracking home builders as well.
Yeah, we were talking about median home sales of existing homes the other day. New homes, the median price, $438,200. That is median. The average sales price a little bit higher. So a new home on average will set you back more than an existing home.
Where's that home at? It's not New York for sure.
Oh, the home that costs that much?
Yeah, right. I want that one.
Can you even still get a studio apartment for that price in New York City?
A friend sent me a link
yesterday.
yesterday.
Not new construction, that's for sure.
Yeah, no. A friend sent me a link yesterday for a one-bedroom in Crown Heights that was about $500,000.
Okay.
Yeah, no. You can get a 4-bedroom, or excuse me, I said 1-bedroom, right?
Yeah.
In Crown Heights, yeah. You could probably get a 4-bedroom in Dallas, Texas for $400,000.
Yeah, well, but you get to live in New York.
Yeah. What a privilege. Coming up, everyone, fresh polling in the Washington Post says 40% of Americans support a TikTok ban. The company's CEO heads to Capitol Hill today. We'll bring you a live look at the hearing and the perspective of 2 experts. That's next.
Welcome back to Yahoo Finance. I'm Julie Hyman alongside Brad Smith. Let's take a look at the latest market action following the Fed's quarter-point rate hike yesterday. The three major averages fell yesterday, also on some comments from Jenny Yellen. Today, though, they are bouncing back, particularly the Nasdaq, which is up by 1.6%. Well, TikTok is facing a potential ban in the U.S. stemming from concerns of TikTok's link to China posing a possible national security threat. Just how much of a security threat is TikTok? By the way, in the opening comments here in the hearing, we get comments from Chair Kathy McMorris-Rogers, who says the facts show ByteDance and TikTok are one and the same. That is just one of the opening salvos here. But let's talk about the technology here. Safety concerns of private and sensitive user data surrounding social media companies. We have Farouk co-founder and CEO Ivan Sarny joining us now. Ivan, thank you so much for being here. You just put out a report which looks into tracking pixels. That is, you're on a website, you see a photo, or you click on the photo, it tracks kind of what you're doing, right? Or an email or what have you. Talk to us about tracking pixels linked to TikTok and how they're being used.
Yes, thanks for having me. And I thought you would ask that. So what are pixels? First of all, they are like mini spy balloons. Remember that giant spy balloon that was shot out of the sky by Air Force? So pixels are tiny pieces of code that follow us on every website that we visit. And we've set out in December to do a study to kind of set a baseline, how pervasive, how many pixels are there and how common they are. And that's what we found is actually was serendipitous discovery that TikTok and other pixels that are collecting user information and sending it to companies that are in the jurisdiction of China or directly to China are pretty common, especially on websites of government, state-level government websites.
Okay, but pixel tagging is not new. I mean, I remember working in marketing and advertising, and you would ask for creative to be pixel tagged before it went into an insertion order that you were running on any type of digital platform. And so the collection of the data has already been taking place in other forms. So why is there more scrutiny around how it's being used within TikTok?
Yes, thanks for asking it. Absolutely. So pixels are very, very common tools. They are very legitimate business tools because companies do need to attract customers. They need to grow, and they use it for marketing. They use it for analytics purposes. The concern that was identified was that pixels collect information that can be used for dual purposes, for business purposes, and also for spying, for example, for unintended purposes, to say at least. And what we have found in the research, which was also validated by Wall Street Journal, is that pixels do get access to information that we may not necessarily be even comfortable with sharing them. For example, we found that health records, when you're booking an appointment, are being read and can be sent or are being sent to places where they shouldn't be being sent to or should not be used by. What was even alarming, we found that even some giant cybersecurity companies had pieces of code on their websites that was collecting information and was sending it either back to China or it was even loaded from China.
To Brad's point, yes, the concern is in particular what is happening with that data. I mean, Google uses these things, Microsoft uses these things, Facebook and Meta. Have the new tools that are put in place, tracking, you can make more choices about how much of your information is tracked. Has that curbed the use of these at all? Does that affect tracking pixels or no?
Thanks for asking again. It's again, pixels are legitimate business tools. One of the main concerns is pixels collect often information without any even organization.
I'm sorry, maybe I wasn't clear. Like for example, when you have cookies and you can cookies, which are similar, right? You can now opt out of cookies. When you do that, are you also opting out of these other tracking tools, or they're not unaffected by that?
Yeah, great question. By the way, what we found is that all of the findings in the report are based on no consent, no people not clicking on accept or reject button. So all of the data collection happens even before you have a chance to opt out.
Okay, and so does any of this tracking, do you believe if there is legislation that will come forward? Because we were just hearing in a conversation from the representative from California, Obernolte, with our own Rochelle Akufo, who was saying that the larger goal here is legislation that will come forward that has more of an approach towards data protection policies. Does that have a larger ranging implication monetarily and revenue-wise for other companies that also have this practice embedded in their business model?
Yeah, my personal opinion, just what I believe is what people want to know is be rest assured that internet is safe to use. Mobile apps and web apps, websites are safe to use, and their information is not going to be compromised or is not going to be used for nefarious or dual purposes. So, and I do agree with the point that kind of to solve this problem or concern kind of once and for all, and first step is to ensure that the people who have access or making decisions who has access to the data or what's going to happen to it should be vetted, almost like if they work for Pentagon. And secondly, and finally, it's strengthening the rules, accountability, and even third-party validation for companies who collect information or who permit for that information to be collected, so that there is accountability of what actually happens with the information.
For Root CEO Ivan Sereni, thank you so much for joining us here this morning and really taking up this conversation as we were continuing to keep a live shot up for our viewers of the hearing that has begun. Ivan, we appreciate the time today. The Biden administration's push for TikTok's Chinese owners to divest of the company is the latest U.S. move on tech and investment controls. Here with more and how this falls against the backdrop of U.S.-China relations and geopolitical tensions. We've got Rija Goujon, who is the Rhodium Group Director, China Corporate Advisory. Great to have you here with us today. First, in just setting the scene as to what's different this time around versus just a few years ago when there was this initial and concerted push for TikTok's U.S. segments to be sold to an American-based business.
Yeah, so it's important to see where TikTok fits in the broader theme of escalating U.S. tech and investment controls targeting China. So if you go back just a few years, remember we had the Huawei precedent in 2019. What did that show us? Well, the sheer power of the foreign direct product rule in U.S. export controls to target major Chinese tech entities. Then we had the October 7th, 2022 semiconductor controls, which effectively have frozen in place China's development of advanced semiconductors. Now we have this growing potential for forced divestment or a ban of TikTok. And this is a real, tech success story for China that has become incredibly politically toxic to Washington, as we're seeing on display today. But that TikTok issue that is front and center right now, it is the catalyst, I think, for something much bigger in play, especially as the U.S. has been trying to get to a more coherent data security policy and in pushing forward existing rules that concentrate on securing ICTS, information and communications technology supply chains.
So, Riva, do you think a ban of TikTok in the U.S. will happen? Do you think it should happen? And what then would be the reaction from China?
Well, if you just look at the tenor of the debate in Washington, it is hard to see how TikTok CEO is going to sway lawmakers at this stage. The Department of Justice and the White House there have been working on trying to figure out a solution to this. Oracle has been a big player in this, trying to work with TikTok and see, okay, what is the data localization solution? What is the algorithmic transparency solution? Tons of resources have been poured into this. But even if you came out with some kind of middle ground solution, will it even be politically tenable at this stage? And that's going to be really tough. So the political trend is moving toward a forced sale or worst case ban. But as you point out, China has a vote in this. And this is where, China is on the defensive now in the face of all of these different building tech and investment controls. China has its own export controls, particularly when it comes to personal interactive data algorithms, which it updated more recently. And so it could decapitate a TikTok forced sale by exercising those export controls.
One of the mechanisms, or at least one of the commitments, I should say, that the CEO of TikTok is going to be talking about, and this in his pre-released or at least filed statements here, is that they're looking to keep safety, particularly for teenagers, a top priority. Second, firewall protection for U.S. user data from unauthorized foreign access, and then also a platform for free expression and not manipulated by any government. They go on and just talk about transparency and access to third-party independent monitors. All of these factors considered, and kind of dovetailing off of what Julie was asking, not only will this be enough to appease lawmakers, but how can TikTok uphold this across not just the U.S. jurisdiction, but every jurisdiction that allows them to operate?
Exactly. And you've already seen a number of different restrictions tighten at the state level. It's even spread beyond the U.S., where some European countries have gotten on board. With some of those restrictions as well on TikTok. So, it's revealing a deeper insecurity around where there may be holes in those firewalls, how to protect personal sensitive data. And then there's that mega issue of where there is a nexus with the Chinese government and the Chinese Communist Party, which is a very hot topic for Congress. If you just look at the policy debate within the House Select Committee that's focused on China right now. And when it comes to that concern over influence campaigns, it's very hard to mitigate that risk through the types of proposals that have been raised so far. So again, it's just hard to see what's a politically tenable middle ground solution in this debate.
Reeve, are there other apps that all the conversation is around TikTok, but are there other ways? Certainly there are other ways that China has of surveilling U.S. citizens and gathering intelligence, right? So is the U.S. making a mistake in focusing so much attention and energy on TikTok itself?
Well, like I said, TikTok is the catalyst, but there is something much bigger in play here. So on March 7th, Senator Mark Warner introduced a very important piece of legislation called the Restrict Act. And this is an act that is very focused on ICTS supply chains and data security. And many have kind of looked at the headlines of that and said, oh, well, this is just about social media platforms. It's just stemming from the TikTok thing. Yes, but it's way more than that. This is a piece of legislation that has heavy bipartisan support. It got immediate White House endorsement. So this has real traction. And the rules are written in a way that would apply toward any ICT product or service where a foreign entity of concern is involved. It's meant to mitigate risks of sabotage, of subversion, catastrophic effects on critical infrastructure, which has a whole list of categories that fall under that. Interference with elections or democratic processes. That's where kind of the social media platform element gets in. And then there's a really broad clause in there that just basically says anything that could pose an undue or unacceptable risk to the national security of the U.S. or safety of U.S. persons. This is meant to be a catch-all. So imagine if this piece of legislation were in play 4 years ago, that would have captured Huawei. It would have captured ZTE, major telecom firms. TikTok is now in focus, but it's important to now look forward to where else this could go. When you have such a foundational legislative framework like this, think about fintech platforms. You've got Alipay, you've got WeChat, major cloud platforms that are China-based. Interconnected softwares, we're moving toward a more digitalized economy, distributed networks and biotech manufacturing. There are lots of applications where there are a range of risks in play, from personal data security, cybersecurity, influence campaigns. It runs the gamut. And this piece of legislation is designed to basically capture that and empower the Secretary of Commerce to take a range of mitigation actions.
And that's a good reminder to not just pay attention to the sort of thing making a lot of noise today, which is the hearing, but also the actual legislation. Riva, thank you so much for your perspective. Really helpful. Riva Gujan is Rhodium Group Director of China Corporate Advisory. Thank you. Oh, we got a trending ticker for you. That is Chewy. The shares are down 7.6% despite a beat on the top and bottom line in the company's latest quarter. The internet retailer of pet items saw active customers take a hit amid continued softness in discretionary spending. Now, it's been experienced across the broader economy with other retailers. However, Chewy says it does anticipate a return to positive active customer growth in 2023. It expects net sales per active customer to continue to strengthen. As for future growth plans, the company is actively building the capabilities and team to launch its first international market over the next few quarters. However, it's the delay of that launch of international markets that is also causing some concern among analysts who are expecting it to happen sooner. Coming up, powering up clean energy. We'll speak with the Saudi Aramco-backed IXIC on the back of its latest funding round. You won't believe what they are using for fuel. We'll be right back. Nearly an hour into the trading session, let's take a check on markets. We see some strength here, particularly in the Nasdaq, up 1.8% today. The S&P up 1.2%, the Dow rising by 0.9%, really largely bouncing back from some of the declines that we had in yesterday's session on some perhaps disappointment that we did not get more supportive comments coming from Janet Yellen in particular. I forgot about Jay Powell for a minute. Communication services, tech, and discretionary are leading the way higher today. Our market check here sponsored by Tasty Trade. Brooklyn-based IXIC wants to transform the shipping industry with ammonia-powered zero-emission cargo ships. The startup secured more than $100 million in Series B1 funding from investors like SK Innovations and Saudi Aramco to help scale their emissions-free technology. Joining us now is co-founder and CEO of IXIC, Sung-Hoon Woo. Thank you so much for being here. First of all, Let's just first of all kind of explain what it is you guys do, because we've talked about all kinds of different fuels over the last decade, up and coming fuels. I have to admit, ammonia is a new one for me. So how is it produced, and how do you make it sort of stable enough to operate as a fuel?
Yeah, first of all, thank you for having me today here. So the company Emoji basically stands for the ammonia plus energy. So we developed a technology which is converting ammonia to power. So by adopting our technology, our customers can finally start using ammonia as a fuel. But ammonia is one of the most common materials in the world, actually, was one of the most produced chemical in the world, which is basically used as a fertilizer. But ammonia has been discussed a lot, especially in the shipping industry, as the potential fuel because of its high energy density and availability. However, there has not been a technology converting ammonia to power efficiently and effectively. So that's the solution that this company is bringing to the market for the first time.
Is this a transition that potential clients could initiate, like right now, with the existing fleets that they have?
Yes, we have already demonstrated our technology in different platforms, such as drones and tractors, and also the Class 8 truck very recently in January. But all these demonstrations, we basically retrofit existing vehicle. So we are also working on the retrofit of the tugboat, converting the existing, the conventional system to our ammonia to power system. So, our technology can certainly be applied to the existing vessel to really decarbonize the powertrain.
And just to make sure we're understanding this correctly, ammonia is considered renewable. What makes it renewable in a way that, for example, petroleum is not?
Yeah, that's a really good question. So ammonia is NH3, so it does not have any carbon molecule inside. So when converting ammonia to power, simply there's no carbon emission coming out of it. That's why the ammonia is really highlighted in industry like the shipping as a renewable fuel. But again, conversion of the ammonia to power has been very difficult, which we have made it easy to using our technology.
I was never great at science, but I love it, which is probably why I do this. So when you think about the cost savings that you're speaking and having conversations with these companies about, what kind of cost savings would they see if they were able to make a switch or a transition?
Yeah, that's a really good question. So of course, our technology in the beginning will likely be more expensive compared to the conventional technologies. However, we have a really clear path to reducing the cost dramatically over the course of the 10 years. So for example, in 2023, which is 7 years from now, we are expecting the cost of our system to be compatible with the cost of the conventional and the propulsion systems used in the maritime vessels.
I want to dig into where you're getting funding a little bit, because Aramco definitely caught our eye as one of your sources of funding. And I wonder, when you're, talking to them and to the other companies that are funding you guys, are you seen as sort of a bridge? Is it an investment on their part as a sort of hedge against a time when we are not relying so heavily on petroleum-based products?
Yeah, Aramco in particular, and Aramco is actually the very first company produced the blue ammonia, which is the low carbon ammonia, and exported to Japan. So they are, our investor Aramco is pretty serious about the energy transition and making it happen using ammonia as an energy carrier, which aligns with our vision of using ammonia for multiple heavy industry and heavy transportation use cases, which is the same for the lead investor, SK Innovation. They're also oil and gas-based company, but they are putting a lot of investment for transitioning to renewable fuels, including ammonia, which aligns well with our vision and the mission.
And so how long does the conversion take so that what was previously ammonia is now usable in the different capacities that you envision it being scaled up for in the future?
Yeah, ammonia itself, we essentially use the existing ammonia, meaning the fertilizer ammonia, as a fuel, not as a fertilizer. But the conversion itself, ammonia to power, if you go a little bit detail of the technology part, we use the fuel cell technology, hydrogen fuel cell technology. So within our integrated power system, we convert ammonia to hydrogen, and the hydrogen gets converted to power almost immediately.
This is really fascinating stuff. Sang-Hoon Woo joining us here today, CEO and co-founder of Emoji. I'm just absolutely fascinated by some of the technology and science that you've been able to move forward. Thanks so much for joining us. Appreciate it. Guys, coming up, Coinbase is in the hot seat over a possible U.S. securities law violation. Yahoo Finance's David Hollerith, he's got more of the details next.
Change up in the Starbucks C-suite. Laxman Narasimhan is the new CEO of Starbucks. Lax, as baristas know him, already set the tone on how he will lead, spending the last 5 months visiting stores, manufacturing plants, and support centers around the world. So what do we know about the first external CEO of one of the world's most popular coffee chains? The 55-year-old executive was born in Pune, India, where he earned a degree in engineering. He then attended the University of Pennsylvania and received a master's degree in international studies and business administration. He's a Verizon board member, a member on the Council of Foreign Relations, and a trustee of the Brookings Institution. Lax started his career at the consulting firm McKinsey, where he spent 19 years becoming a senior partner. He served as a global chief commercial officer of PepsiCo before joining the London-based company Reckitt Benckiser, the parent company of Lysol. Laxman was credited with boosting sales during the COVID-19 pandemic and led the company through the baby formula crisis here in the U.S. with the Enfamil brand in its portfolio. Over the course of his 3 years as Reckitt's CEO, investors saw the stock rise 8%. The reason he left that top spot? Starbucks. Narasimhan takes the helm in what former 3-time CEO Howard Schultz calls a new era for the company. That new era will likely include working with union organizers, Starbucks' growth strategy, expansion into China, and the rollout of its new olive oil coffee line, Oleato. And the stakes are high. Investors hope Lax's global perspective could drive growth in both mature and emerging markets for the coffee chain.
As I look at value creation, this is the model that is core to the value creation model of the company. And if we do it right, the opportunity set is limitless. And I know what it will lead to is outsized returns for our shareholders.
And you may be wondering, what is his favorite drink? Well, one that will keep you going. A Doppio espresso macchiato with hot skim milk on the side.
Coinbase is in the hot seat after the SEC accused and issued the crypto exchange a notice warning of potential violations of the U.S. securities law. Yahoo Finance's David Hollerith joins us now to answer the question, what do Soulja Boy Lindsay Lohan and Jake Paul all have in common? David.
Well, so Brad, you're pointing out that yesterday Coinbase made this disclosure that the SEC had sent it a Wells notice letter, and obviously this came within an hour or so of another action that the SEC had announced, which was against Justin Sun, the founder of the cryptocurrency or blockchain network and token Tron or TRX. And related promoters who had been promoting the cryptocurrency. The SEC accused them of offering the sale of an unregistered security. Also, the promoters for being part of that, and given the fact that they also pointed to wash trading conducted by TRX or the Tron Foundation for allegedly, buying and selling or trying to stimulate volume for the cryptocurrency. But this Wells notice from Coinbase that Coinbase disclosed through a regulatory filing is kind of interesting in that it's a long time coming and there's a lot of context for this, given how many crypto cases we're looking at. The SEC has put down 11 enforcements against crypto firms and individuals since the beginning of 2023. But, what's striking about this notice, Coinbase also put out a blog post, and its CEO, Brian Armstrong, also posted a tweet thread that showed that the company was fairly confident about its position. Now, in the Wells notice, it's not exactly clear what the SEC is going after, but Coinbase said it believes any action the SEC might take after following this Wells notice would be specifically related to the crypto assets they listed on their platform, and this would include aspects of the exchange's spot market staking service and wallet services. So this would be like a probable injunctive relief, disgorgement, and civil penalties if the SEC were to put out an enforcement action. But the Coinbase has been pretty adamant and clear that they would plan to fight any kind of enforcement action in court. The chief legal officer, echoing the CEO in this blog post, had said that Coinbase is confident of the legality of its assets and services, and if needed, would welcome a legal process to provide further clarity to the crypto industry. And in his words, he said, the SEC simply has not been fair or reasonable when it comes to its engagement on digital assets. So there's a lot going on there, but it sounds like Coinbase is pretty adamant about its position.
Another story you're following that also has implications for the broader crypto space, right? I think that's why Coinbase's story is interesting, not just because it has implications for Coinbase, but what's it going to mean for other crypto companies? Similar situation with Ripple. It's been rallying this week. It has its own legal battle with the SEC. That's been going on for a long time, and maybe is coming to a conclusion soon.
Yeah, Julie, there are a handful of lawsuits between the SEC and crypto firms, and the SEC in the U.S. has been very actively trying to take more regulation over the crypto space. Ripple's ongoing case started in 2020, which sort of makes it the oldest of the cases we've been watching. And for years, the case's verdict has hinged on whether or not certain cryptocurrencies, in this case, the Ripple's related token, the XRP token, would be classified as a security under the Howey test. And the XRP token, as you pointed out, has rallied. And, the thing that I would point out to, just looking at the court docket, has been Ripple has posted another court case, the Voyager Digital's bankruptcy, in which the judge ruled in favor of a sale of the customer assets to Binance US. This was after this was after the SEC had objected to the sale, calling Binance US or alleging that Binance US was an unregistered securities exchange. In that case, the judge, in his verdict, said essentially that the SEC hadn't offered enough evidence to prove that this was true. So this is kind of what's been happening in a lot of these cases, including Grayscale's, which it's filed against the SEC and is currently also happening, is that the SEC has not been offering enough burden of proof as to whether or not these crypto assets are securities. And so, we're going to continue to watch this. But I mean, I think the question here remains to be seen about which case is going to be the first to get a verdict, and how much will that implicate the other ones. I mean, if Coinbase were to have a court case, this would obviously take up to years. Ripple, on the other hand, is set to conclude sometime this year, hopefully soon.
We'll find out. All right, thanks so much. Appreciate it, David. Coming up, what the Fed's latest move means for the real estate sector, in particular commercial real estate, which has gotten a lot of attention as of late. We'll speak with the CEO of Marcus & Millichap next.
Quantitative tightening, QT. Now, this is something that you may have heard in the mix over the last several months. Let's talk about exactly what this is. This is when the Fed shrinks its balance sheet. How they do it, they let some of the securities mature and fall off the asset side of the balance sheet. They do this when the economy is in overdrive and inflation is running very hot, certainly something that we have seen play out over the last several months. So let's talk about exactly what the Fed's balance sheet is too, because when you talk about the fact that they are rolling off some of those securities, you might think, wow, that's a heck of a lot of money. Well, the Fed's balance sheet, $8 trillion. $5 trillion of that is treasuries, and more than $2.5 trillion of that is mortgage-backed securities. Right now, QT is capped at $95 billion a month. So how does this impact you? QT could pressure bond prices, which then pushes up yield, so affects everything from bank lending to the mortgage market and also to you, the investor.
Real estate is finding the positives in Powell, well, a little bit at least. Remarks from the Fed chair yesterday hinting at the end of rate tightening. The news may come as a relief to real estate markets hoping for a timeline, but will that guidance be enough to offset the more immediate rise in rates that's already putting pressure on the sector? Joining us now is Hassam Naji, Marcus and Millichap CEO. Thank you so much for being here. And commercial real estate has gotten a lot of attention as of late, right? There's been a lot of discussion about whether this is one of the areas of vulnerability as we are seeing rates move higher. What can you tell us about that from inside the industry?
Good morning. Thanks for having me on the program. Well, the industry has been under a lot of pressure really since fall of last year, when the successive interest rate increases really created a challenge in valuing commercial real estate, given the extremely rapid rise in the cost of debt. Commercial real estate is very dependent on leverage. On average, we have somewhere between a 40 to 60% long-term average use of leverage in the transactions that occur throughout the United States. That's gone up as high as 70 or 80% at various times of different cycles. But nonetheless, that is a significant portion of what makes a transaction work. And the shock to the marketplace from the successive and very aggressive rate hikes last year are still being absorbed. Now, the fact that yesterday we saw a quarter point movement instead of the half a point movement that was planned prior to the banking crisis is a positive. Not so much because of the rate is lower than the 50 basis points, but the signaling that the Fed is nearing its tightening cycle. It's really taken a sledgehammer to the real estate market in a way that the successive increases were so dramatic and could have been done at a much slower pace if the Fed had started tightening in 2021. So the catch-up factor is what's really hurt the transaction market and the underwriting. So far, what we're seeing is sellers and buyers having to recalibrate on what the true valuation of commercial real estate is. Of course, that varies by property type and marketplace, but we're still in that recalibration phase of price discovery. The clarity that the end of the tightening cycle will bring is a positive move. Second to that will be clarity on whether we're going to have a recession or not. We still believe this is going to be more of a slowdown than a major recession. The employment market is still way too strong and has a lot of great foundation, as does the consumer, to point to any kind of a dramatic, serious recessionary forces coming into the picture. So with those two things coming together in the next few months, I think there will be the more clarity, but the market needs time to absorb this readjustment of valuations.
So trying to synthesize all of that, what would be in your calculus for either shallow or severe or mild, whatever it looks like, type of recession, the knock-on effect on the real estate market, considering that, it's not normal for rates to be at zero or near zero for as long as they were, and for the market to be able to set its own positions around that, and then now have to normalize when rates are actually getting back towards levels that many would say are actually perhaps a little bit more normal.
You bring up a great point in that a 5% federal funds rate is not all that unusual and actually considered a normal interest rate. We're coming to that 5% federal funds rate from zero at a very quick pace. That's what's really shocked the markets and created this dislocation. Had that process been more gradual, had the Fed had been a little bit further ahead of the curve on inflation and not relied on the transitory judgment that was placed on what we were seeing in 2021 post-pandemic, we wouldn't have caused as much of a shock to the marketplace. So you're right, it's the absorption of that shock that's going to take time. Meanwhile, the unintended consequence of this rapid rate increase, of course, has showed up in the banking system. And there is a lot of concern about mortgage performance for commercial real estate. Commercial real estate is a significant part of the asset holdings throughout the banking system in the United States, particularly regional and local banks. The good news is when the current loans that are maturing were issued, 5 to 7 years ago, values were a lot lower than they are today. Occupancies and rents were a lot lower than they are today. And the foundation of commercial real estate assets is much stronger than it was going into 2008, 2009, because we haven't overbuilt, we haven't over-leveraged, And all of that gives the industry a lot more of a solid footing going into this rather uncertain phase of what's going to happen with the maturing loans. So having said that, there's going to be some non-performing loans. We're seeing some office buildings get handed back. We're seeing some challenges in refinancing maturing loans that are coming due that were short-term loans, maybe issued 2 or 3 years ago with a very short-term maturation cycle. And some of that is going to be problematic in the marketplace. And part of our job as advisors and brokers is to actually solve those problems with our clients, which we're actively doing. And there is a wide gap between the performance of, let's say, office buildings right now and multifamily properties and retail, for example. Those are all performing at a very different level.
But it sounds like overall that the perception that there is this huge bomb lying in wait or bombs lying in wait on balance sheets, especially bank balance sheets, it sounds like your message is that that's mistaken, or at least has been overstated by quite a bit.
I agree with that. Overstated is probably the best way to describe it, in that there will be issues. I don't want to gloss over that. But I just don't think it's going to be as systemic as some of the panicky headlines have suggested. And we've seen lenders work out solutions with owners when there's been those kind of maturing loan situations or bridge loan necessity to kind of help an owner get through a particular period of time in the cycle where we're having these forces come at us that are very unusual. You have to remember, commercial real estate has been through a pandemic, a very rapid recovery, and then a massive tightening of financial conditions, unlike anything we've seen in modern history. So the last 3 years have moved the industry through a significant roller coaster.
And so with that in mind, isn't it kind of a viable argument that the environment for commercial real estate has changed so drastically, whether that be the office workplace, whether that be a retail storefront footprint, all of that has dramatically shifted?
It definitely has, not all in a bad way. There's always opportunity in commercial real estate. In every down cycle, we've seen those investors that can reimagine a piece of real estate or can basically think long-term, whether it's holding onto an asset or investing in new assets, come out as winners. And this is no different. What we're seeing is a dramatic difference between property types where, in a way, you can call office the new retail, because retail for the last 10 years was going through a complete revolution because of e-commerce. Brick and mortar retailing was changing in every way. And what emerged from that was the experiential retail, fitness, and health-oriented retail that has been so successful, was successful before the pandemic, has become successful again post-pandemic, and is driving retail to be, in many ways, the darling of the industry. That is a contrarian move. If you think about 4 or 5 years ago, when those investors that went into shopping centers, made those very important moves. On the other hand, office buildings, because of the hybrid workplace, because of the migration to the suburbs, especially office buildings in urban areas, have been hit very, very hard. We still have leases that have 3 to 4 years left on average. And when those renew, we're going to see shrinking of footprints and lower demand for office space, but not as bad as it seems today, because we're still recovering from the post-pandemic effects. Nonetheless, there is definitely shifts. Multifamilies coming out as a winner because home affordability is now a major issue, and people are opting to rent again instead of buying homes, given what's happened with interest rates. And then you have other property types like self-storage, for example, or manufactured housing, or life sciences that are doing extremely well.
Yeah, no, it's a great point. In terms of office certainly becoming the new retail in Brookfield's case, and then additionally retail becoming the new experiential or gym in Lululemon's case, and then you can go on and just how storage is becoming the new data center, basically. Assam Naji, who is the Marcus & Millichap CEO, thanks so much for joining us here this morning. Appreciate it. You guys, coming up, Moderna was grilled by Senator Bernie Sanders over its COVID shot price hikes. Yahoo Finance's Anjali Kamlani has the recap. That's next.
Are you prepared to substantially charge less for the vaccine to the United States government and our agencies?
Given the situation at hand, Mr. Chairman, we have no idea of the volume that we need this year. We have very increased complexity.
Yeah, you have complexity, but you have money for stock buybacks by the billions, and you guys became billionaires. That doesn't seem too complex to me. Let me ask you this question at least. The United States pays, the people in our country pay the highest prices in the world for prescription drugs in general, something this committee will work on. Will you at least tell us today that the price you are charging for the vaccine will be lower than what other countries around the world are paying? Or are, once again, we going to pay the highest prices?
So, Mr. Chairman, the price will depend on the value in each country. The cost of healthcare is different in each country.
That's not the answer.
That was Senator Bernie Sanders and Moderna CEO Stéphane Bancel in a heated conversation about the cost of the U.S. government and consumers paying for the COVID-19 vaccine. So why exactly does Moderna want to quadruple the price after years of record profits? And what does that mean for the company's stock performance? Yahoo Finance's Anjali Kamlani has the details on this Bernie Bancel brouhaha that took place yesterday.
It was a sight to see, I'm telling you. But so let's break down what happened. We know that Moderna and Pfizer, by the way, are going to be increasing their price per dose to $130 or in that range. What we did get out of this hearing yesterday was that, number one, that Moderna is in negotiation with all of the payers. So that is going to be the government agencies as well as insurers on what that final list price is going to be. But out-of-pocket cost for Americans is supposed to remain zero. That's what the CEO told the committee yesterday. Meanwhile, we know that costs are going to be increasing for the companies. That includes Pfizer as well, because they're shifting from the government taking control of distribution, as well as those 10-dose vials to reduce to single-dose vials or pre-filled syringes. And they're expecting costs coming from that, as well as incurring the cost of loss, because they do not yet know what that market is going to look like, right? This fall, when we hear the booster cycle, we're not sure how many people are going to take those doses. And so they're kind of flying blind right now. And we heard Stéphane Bancel say yesterday that there's market analyst consensus that the company is going to be at a loss this year, and that they may well, lose out on that status and all that cash that they're sitting on. It's just going to have been a one-time pandemic windfall. So that's sort of the back and forth that we saw happen yesterday between Senator Sanders and other members of the committee, as well as CEO Stéphane Bancel. And really at the core of the argument is why Moderna specifically, who got a lot of investment from the federal government, is now turning around and raising prices to match what the market, competition is. And so that's really, the basis of the conversation yesterday.
Yeah, really interesting stuff, and sort of gets to questions about capitalism more
all
broadly. It's big questions. Thanks so much, Anjali, for continuing to track it for us. We got a lot more on tap on Yahoo Finance today. Rashila Kufo is on the ground on Capitol Hill. She's giving us updates all morning along with the latest happening from the hearing with the CEO of TikTok.
We'll also continue our coverage of the Fed as markets digest Fed Chair Jerome Powell, and Treasury Secretary Janet Yellen's comments. We'll speak with a Harvard professor of economics about the systemic risks of the Fed's moves.
I think that's Ken Rogoff, who's always an interesting person to talk to. And we're fresh off some housing data. We'll get a check on the state of the housing market and what it all means for the economy. All of that coming your way. Just wanted to... Well, that's it for us. We've got all that and more. Jared Blickery's got you for the next hour of the trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here's what I am watching. Facing the fire, TikTok CEO is being grilled in a much-awaited congressional testimony. Lawmakers painting a picture of the company linked to the Chinese Communist Party and posing a grave threat to American life. That's a quote. We're going to watch live on the Hill as it all unfolds. And getting a tailwind. Stocks higher as investors bet on a quicker end to rate rises. Speeches from Jay Powell and the Treasury Secretary Yellen crossed over each other yesterday, and stock markets had a tough time decoding it all. We're going to do all the work this hour. And we keep an eye on slumping block shares after short seller Hindenburg publishes a scathing report on the group. It alleges Jack Dorsey's company is facilitating fraud. We're going to bring you all the details and the context you need. But first, let's take a look at the major indices. We can see we're in an uptrend here. Up day, we got the Dow up 454 points, the S&P 500 up 1.5%, and the Nasdaq just soaring up 2% the day after Fed Day. And let's check on the Treasury market as well, where we can see a different picture for bonds. We see they're heading south. We got the 5-year yield down 6 basis points, the 10-year down a modest 2 basis points, and the 30-year up 3 basis points to 3.73%. Now turning to our top story, TikTok CEO Shou Chew testifying today before Congress as calls grow around a potential ban of the popular social media app. TikTok is just one part of an increasingly acrimonious tension between the U.S. and China. Yahoo Finance says Rochelle Akufo is live in Washington with the latest. You are on the floor. What is the latest, Rochelle?
I mean, it's been a very tough morning. If I would say the overarching theme of this morning's testimony so far is that it's I don't buy it. A lot of lawmakers really questioning not just TikTok itself, but also its relationship with ByteDance. Now, Chair Rogers of the House Energy and Commerce Committee really set the tone by saying that we don't trust that TikTok will ever embrace American freedoms. She then went on to lay out some of the more damaging parts of TikTok that she alleges, and really also talked about this 150 million monthly active users in the US. Now, this was something that Shou Chew really highlighted as a positive for the growth of the company on his TikTok before this testimony, but instead she said that this actually really emphasized the urgency for Congress to act. She also talked about the backdoor for China to access some of this user data across the platform. And of course, also talked about ByteDance specifically, saying it's beholden to the CCP and targets our children. She talked about the algorithm promoting harm to children, even brought it up as a potential what she called a portal for drug dealers to sell fentanyl. All of this, of course, really increasing the urgency for a need for national privacy legislation. Now, of course, TikTok CEO Shou Chew had a chance to lay out his testimony regarding the commitments that he's going to be making with that app. Take a listen.
Number one, we will keep safety, particularly for teenagers, as a top priority for us. Number two, we will firewall protected US data from unwanted foreign access. Number three, TikTok will remain a place for free expression and will not be manipulated by any government. And fourth, we will be transparent and we will give access to third-party independent monitors to remain accountable for our commitments.
Now, you have to remember, when this hearing first started, Chair Rogers said that TikTok would essentially say anything and is now trying to make these commitments at the 11th hour. Now, Shou Chew did try and compare TikTok to some of these other social media companies that perhaps have the same issues as well, but lawmakers still kept honing in on TikTok, saying, what about your specific commitments? How can we believe you? And how can we believe you about your relationship between the CCP and US data ending up overseas? Something else that there was an exchange between Representative Pallone. He said, would TikTok commit to not sell data to anyone? And at one point, Shou Chew sort of tried to narrow the focus and talked about data brokers. He said, no, would they not sell it to anyone? He said, I will get back to you. Also, when it came to targeted marketing, he said, I'll get back to you on that. Another issue, would they commit to not gathering or dealing with location or health data without affirmative consumer consent? Obviously, a lot of people wondering what happens to their data. Should they be allowed to opt out of it? Are they really aware of what they're signing up for? And something else that we heard mentioned a few times is Section 230. Now, that refers to Section 230 of the Communications Decency Act. Now, that covers unclear and inconsistent moderation practices that limit speech and go beyond the text of the existing statute, and also addresses the proliferation of illicit and harmful content online. So lawmakers were asking Shou Chew, should TikTok have these protections, and really talked about the reforms that are needed to really cover some of the potential risks that they do see with TikTok, Jared.
Thank you for that, Rochelle. And we're going to be dipping in and talking to you throughout the day here. And for now, we want to continue the conversation on TikTok's political turmoil, the app under fire over allegations it can be used for spying or to influence public opinion on behalf of China. Talk of a TikTok ban first began during the Trump administration by way of history here. Joining us now, Keith Krach, chairman of the Krach Institute for Tech Diplomacy at Purdue and former Undersecretary of State under the Trump administration. Keith, thank you for joining us here today. You were just listening to Rochelle outline some of the what's been going on here, but just big picture, there's bipartisan support for this. How did we arrive at this point here?
Well, this is one of the most unifying issues on Capitol Hill. Both sides of the aisle agree that the Chinese Communist Party is the top national security threat. And they understand that China's playing the long game. They're playing for keeps, and technologies their key weapon. And no matter how you look at it, TikTok is controlled by China, by the Chinese Communist Party, from a structural standpoint, from a legal standpoint, from a data governance standpoint, and also from a leadership standpoint. And the fact of the matter is TikTok is programmed to be weaponized. And if China can weaponize a balloon, think at what they can do with 150 million Americans at their mercy.
So we have this very popular social media app in the U.S. It looks like Congress may take some kind of action here. But what is the potential? What are some of the potential solutions here? Even if Congress doesn't take the action, you were involved in some with the previous administration. Just what are the options that are still on the table at this point?
Well, I think the big option that's on the table is the PROTECT Act, which would give the authority to the Secretary of Commerce, Gina Raimondo, to ban any technology from our adversaries that's a national security threat. One of the other options as well, and we did this when I was Undersecretary, is the Clean App and also Clean Store. So Google and Apple can remove it from their phones. There's and obviously there's a lot of things that are going on in the states. 30 states have banned it, universities have banned it, those kind of things. But if you look at what TikTok is doing, so they're tracking every keystroke. It gives them access to everything. But the thing that's really interesting is that it's not just about you as the user. It's about everybody you digitally interact with your friends, your business associates, your family. It's like a weaponized digital virus. And the TikTok virus can infect everybody around you. So that's why really the only vaccine is a total ban.
I want to get into, we'll save this for a minute, into some of the Communist Chinese Party's potential uses for this. But you mentioned Apple and Google. These are two linchpins in the app distribution network. And arguably, almost without a shadow of a doubt, that TikTok is operating in a huge gray area with respect to their policies. If Apple and Google were to remove the TikTok app from their platforms, that would immediately accomplish a lot of the goals that you're seeking. I'm just wondering what kind of pressure to date has been on these two huge tech companies to do something like this?
Well, I think there's been a lot of discussions along those lines. We had discussions with them. What they will do is they will obey the law. And that's why this piece of legislation is absolutely so critical. Because if you think about it, what TikTok is, what Huawei is, what Tencent is, all these Chinese apps, they're an extension of China's Great Firewall, where all the data comes in for their own malign use, but none goes out. And then reciprocally, all the propaganda goes out, but the truth does not come back in.
And you write and talk about some of the fusion between the military and the civilian populations over in China. And you mentioned the weaponization of this technology. Could you just go into some detail about the potential bad actor uses of this?
Absolutely. So, it tracks your keystrokes. That means that they can see your bank records. They can see your health records. They can track where you are, where you've been, potentially where you're going. And think about if a conflict breaks out, what they can do with that information. They have access to all your passwords, all of that. So this app is built to be weaponized And the other thing too is that I've got 11-year-old twins, and this app preys on children. It is built to be addicting. It's disguised as candy, but it's really cocaine.
I mean, you could describe several social media apps as cocaine potentially. I'm just wondering, without you get rid of the weaponization features, is TikTok really more harmful than, say, an app like Snap or Instagram in the US?
Well, by the way, there's social media and then there's TikTok, and there's no comparison. Big part of it, and this is coming out in the hearing, is that China has a National Intelligence Act. And here's what it says. It says that any Chinese company, state-owned or otherwise, or any Chinese citizen has to turn over any information, data, proprietary technology upon request to the Chinese Communist Party, or you suffer the consequences, you go to prison. So they are obligated by law. That is the huge difference.
All right, we have to leave it there. Really appreciate your insights. Keith Krach, chairman of the Krach Institute for Tech Diplomacy at Purdue and former Undersecretary of State. Thank you. Coming up next, markets digesting mixed messages on banking deposits from Treasury Secretary Janet Yellen. We break down her comments after the break. Welcome back. Turning to the U.S. bank fallout, markets digesting mixed messages on banking deposits from both Treasury Secretary Janet Yellen and Federal Reserve Chairman Jerome Powell. Yellen said before the Senate that she has not considered or discussed blanket insurance to U.S. banking depositors without approval from Congress. That happened at approximately 3 p.m. Eastern time yesterday, just after Powell said that the banking system was safe. Here to cut through the noise and break down what this means for the financial system is Yahoo Finance's Ines Ferre. Ines.
Jared, and at the heart of this is really whether the U.S. government would consider making whole depositors that have the limit of more than $250,000 of the FDIC limit, like they did with SVB, like they did also with Signature Bank when regulators bailed out those banks. Now, the FOMC, at the FOMC presser yesterday, Jerome Powell said some comments to try to calm depositor concerns, saying we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system. He went on to say that depositors should assume that their deposits are safe. Treasury Secretary Janet Yellen has testified recently, and her messaging has been a little bit more mixed, or walking a fine line, because on the one hand, she said comments like similar actions, referring to backstops, could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. But she has gone on to say, I have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits. Now, this kind of jives also with an exchange that she had last week with Oklahoma Senator James Lankford, who basically said, look, the small community banks in my state, what is to say that large depositors with more than $250,000 in those banks are not going to leave those banks? What type of treatment will you give those banks? And she basically said that the banks would get that treatment, the same treatment as SVB or Signature Bank, if they pose a systemic risk. And that is really what the market is concerned about, whether or not regulators will do something so that depositors over $250,000 will get their money, whether they're at a big bank or they're at a very small local bank. And the only ones that can do this is Congress. Congress is the one that has to act in order for that $250,000 limit to be upped. And so far, legislators have not moved the needle on that. So basically, you have Janet Yellen and Jerome Powell saying, look, the banking system is safe, no need to panic, depositors are okay. But there is no guarantee that they will be okay regardless of the size of their bank.
It sounds like lots of gray area and operation in between. And as always, nuance matters. So thank you for that, Yahoo Finance's Ines Ferre. The Federal Reserve, as we know, raised interest rates by 25 basis points, or 0.25% on Wednesday, and signaled that its rate hiking campaign may be nearing an end amid concerns about stability in the global banking system. Is this a sign that inflation has peaked, or is a risk in the banking system causing the Fed to be more cautious? And if so, what can we expect from the central bank going forward? Here to discuss is Pence Capital Management's Chief Investment Officer, Dryden Pence. Thank you for joining us here today. And just reading through your notes here, I like acronyms here, and you're talking about a potential transition in narrative from there is no alternative in bonds to bonds are back, y'all, baby. So from Tina to baby, can you kind of explain what you're thinking here?
Absolutely. So for so many years when we had zero interest rates, you had this, there is no alternative market, forcing people into equities. But now that we've had this rapid rise in interest rates, bonds are now a legitimate and meaningful alternative for investors who are looking to build income and value in their portfolios over time. So that's why we moved from Tina to what we call baby. Bonds are back, y'all. And when you can look at a situation where with minimal risk, a person can get between 4 and 5% on short-term money. That changes the planning considerations of a lot of people and how they are going to think short and long-term about their portfolios. It makes a big difference. It's a sea change that we haven't had in like 15 years. And I think it's very, very important for people to pay attention to how significant that opportunity is in their long-term investment profile.
Yes, and as part of that sea change, we had an absolutely disastrous year last year in both bonds and equities. I'm wondering if you expect any kind of revaluation this year similar to what we had last year with tech. And just in general, what do you like in equities right now?
Well, talking about the revaluation, you see, the reason why you had this massive change in bonds last year was you had this very rapid increase in interest rates driven by the Federal Reserve. When we're nearing the end of that cycle, and I think we're going to find a much more stable interest rate environment going forward. Fed probably has, a quarter point left maybe, and then they hit a pause button for quite a while, and then we're going to move from a regime of rising interest rates to possibly lower interest rates, but we don't see that till 2024. So I think that environment is important. And when we move that to equities, Jared, it's important to recognize that companies right now have a hard time predicting their total cost of capital because interest rates are rising. They don't know when the Fed's going to stop. Once that happens, then companies can understand their cost of capital and payments in terms of trade, and companies adapt. So you'll begin to see earnings estimates, forward guidance, and all those things get a lot better for equities going forward once the Fed hits the pause button. Now, if we talk about sectors, we like
yes.
defense. Yeah, okay. We like weak sectors, and we can talk about some companies as well. But we like defense because the war in the Ukraine may end at some point. But even when it does, the world has learned a valuable lesson. NATO has learned a valuable lesson. There used to be 9 countries that spent 2% of their GDP or more on defense. Now it's gone to 19. And so when you look at the interoperability agreements inside of NATO, U.S. companies like Lockheed Martin and Raytheon currently have a 2.4 times 2022 revenue order book. They're basically booked up for the next two and a half years. The Javelin missile cost $175,000. We pay for it. It takes out a $3.2 million Russian tank. I like the math. And I think that trend is going to continue. So we like defense. We like healthcare because tremendous healthcare expenditures are going up. A lot of the money is provided for the government, and we think that that's going to be stable going forward. And we also like infrastructure. So infrastructure because we have a large transportation bill that has been funded. There's $500 billion running at infrastructure companies. We've got to rebuild our roads and bridges. So those are the 3 things that we think are really stable in this environment that continues to be somewhat volatile.
All right, we got time for one more. I'll give you the floor. Anything you'd like to highlight to our audience here in terms of investment opportunities or what you're seeing on the horizon?
Well, I think we have to recognize that the Fed is probably going to go up maybe one more and then pause. And I don't think we see a pivot until next year. And I think that that's very important. I think it's very important for people to consider that we've only seen the net effect of about half of the Fed raising so far. Lags are 4 to 9 months. And so when you're thinking about your portfolio, you've got to recognize that all of the Fed action is yet to work its way through. So we're going to probably see a minor recession in the last half of the year, but that creates opportunities. And the sectors that we like, and I mentioned United Health. I didn't mention United Health, but I'll bring that one back. But defense, healthcare, and then infrastructure. Those are areas that you have resiliency in this market that's going to be somewhat volatile going forward.
All right, appreciate that. Pence Wealth Management's Chief Investment Officer, Dryden Pence. Thank you. And checking in on the markets here, sponsored by Tasty Trade. We got a rally day on Wall Street. Look at the Dow up over 400 points. By the way, this is the best day, well, on track for the best day of the year so far. S&P 500 up over 1.5%, and the Nasdaq cracking 2.25% to the upside. Quick check at the bond market. We did see yields heading lower. And coming up, Fed Chair Powell says there is more work to be done to get inflation down to 2%. Stay tuned as we discuss the bigger picture of the Fed's job right after this. Welcome back. Despite yesterday's quarter-point interest rate hike, Fed Chair Powell says there's more work ahead to get inflation below the Fed's 2% target. Here with a look at all of this and what it means for the bigger picture is Kenneth Rogoff, professor of economics at Harvard University and former chief economist at the IMF. Ken, really great to see you here today. Big picture. You've been writing about this in the FT, and you've gone back over 700 years with respect to interest rates and longer-term interest rates. And I want to get your broad strokes as to what this means for the current economic environment, because we saw a huge dip in rates over the global financial crisis that lasted for years. And I believe, and correct me if I'm wrong, you're saying probably not going to happen this time around, and we're probably facing higher inflation that the Fed is going to be fighting for years to come. Just wondering if you can put that into some of the terms and what you discovered in your work.
Well, I mean, simply put, there is a very slight downward trend in real interest rates over long periods. Think of a 1 to 2 basis points a year. But the 10-year Treasury forward-looking inflation index interest rates or other comparable ones around the world fell 200 to 300 basis points in a short period after the global financial crisis. And that has happened before. And typically when that does happen, there's reversion to mean. It's not super fast. It might take 5-10 years, but it's not permanent. And so I think the expectation should be that real interest rates are significantly higher over the next decade. Now, will they be significantly higher over the next 6 months? Well, if we go into a deep recession and there's a financial crisis, maybe not. But I think they would come back pretty quickly. This isn't like 2008. We have inflation, which really wasn't an issue then. We have a huge shift in public and private debt from the financial crisis, from the pandemic. There's big expenditures needed for defense, for green energy transition. Populism is pushing, a lot more transfer of income and spending, a lot of pressures pushing up interest rates that are the proximate reasons that this is probably going to, see higher rates. So I worried about some kind of financial crisis coming quite some time ago, because inevitably it does when you have a shift like this.
And here we are, we have at least a banking panic, and you're writing, and you wrote in the FT, you're surprised, or we should be thankful, that this did not happen sooner. Can you can you lay out some of your reasoning here?
Yeah, simply put, obviously when interest rates have been ultra low for a long time, and different people react to that differently, but a lot of people sort of, went very long on that idea that they've been below forever, and it was a good moneymaker for a long time. And then when they go up, you get caught out. I mean, what happened to Silicon Valley Bank is maybe a little extreme in its naivete, but almost any kind of investment strategy that had illiquid assets, longer term assets, is going to lose money like this. Now, I first was writing about this a few months ago. I didn't know it would be in the U.S. banking sector. I was thinking, I don't know, maybe Japan, Italy, which might still be yet to come. But it's a worldwide phenomenon. This isn't a U.S. banking problem. Obviously, we had the Credit Suisse, but it's much broader than that.
And I'm wondering, you're also talking about in the article some of the problems with commercial real estate. They operate on a much longer time frame than, I guess, than other parts of the real estate market in terms of residences. I'm just wondering what the potential fallout there is, and what anything that you're seeing on the horizon for commercial real estate.
Well, I mean, the situation with commercial real estate is quite grim, clearly, in the United States, especially, where office occupancy is maybe half of what it was before the pandemic and doesn't see signs of springing back. And at the same time, interest rates are going way up, which would have been bad for commercial real estate even if we didn't have the pandemic. It may be that that's something that just drips out over time. Banks, financial firms lose money. It affects lending conditions, but doesn't lead to a crisis. I think the point is that even if nothing further happened besides what happened 2 weekends ago and with Credit Suisse, we are going to see tighter lending conditions. Chair Powell emphasized that yesterday. First of all, they're worried. Some small banks are losing money to big banks, and they do a lot of the lending. They're worried. The regulators are coming for them after they've done this massive deposit insurance, and there's general nervousness about what's next. So that's when a banking crisis, it's the tightening lending conditions. That's the big thing that hits the economy. So we're certainly going to see that. That said, if we're looking at the world as a whole, I believe we're just experienced the first wave of this, and there are more to come. Not necessarily next week, 2 weeks. Remember the European debt crisis? It was sort of, 1 month Greece, and then a couple months later Ireland, and a few months later Portugal, et cetera. That's a very typical pattern in which these things unfold.
Yes, and the key back then was Draghi, head of the ECB at the time, saying anything it takes, and just pledging that underlying support, bringing it back to the present with Chair Powell and what you were talking about, increased lending standards or loan standards, probably going to decrease the amount of loans in the economy. That has the same effect as the Fed increasing rates, which was something Powell was talking about yesterday. You think the Fed is on the right track here, raising rates 25 basis points? What should they be doing heading into the next meeting and thinking about that?
Oh, well, let's face it, this was as soft a hike as they could do. That's why the markets are reacting favorably. They could have either paused and said, we're probably going to hike next time. And instead, he hiked and kind of signaled that if things are still, unstable in the banking system, they're probably going to pause next time. So, on the whole, the market saw this, I think, positively. I don't know if they're right, because core inflation is still strong, and the U.S. economy still, it hasn't gone into recession yet. It might well. So it's very hard to know what's next. I thought Powell actually played it really well, being transparent, but, quite honestly saying he didn't quite know where it was going next.
I have to agree with you. I think Chairman Powell has finally gotten the knack of these press conferences here. Not too many big surprises. All right, really appreciate your insights. Thank you, Professor Rogoff, here for joining us today. Coming up, new home sales in the U.S., they rose 1.1% in February. But what's the mean in terms of buyer? And what does it mean in terms of buyer confidence as mortgage rates continue to climb? We're going to break it all down next.
Quantitative tightening, QT. Now, this is something that you may have heard in the mix over the last several months. Let's talk about exactly what this is. This is when the Fed shrinks its balance sheet. How they do it, they let some of the securities mature and fall off the asset side of the balance sheet. They do this when the economy is in overdrive and inflation is running very hot. Certainly something that we have seen play out over the last several months. So let's talk about exactly what the Fed's balance sheet is too, because when you talk about the fact that they are rolling off some of those securities, you might think, wow, that's a heck of a lot of money. Well, the Fed's balance sheet, $8 trillion. $5 trillion of that is treasuries, and more than $2.5 trillion of that is mortgage-backed securities. Right now, QT is capped at $95 billion a month. So how does this impact you? QT could pressure bond prices, which then pushes up yield, so affects everything from bank lending to the mortgage market and also to you, the investor.
Welcome back. U.S. new home sales, they rose 1.1% in February to an annual rate of 640,000. What does this mean for the state of the housing market? Here to break it all down is Yahoo Finance's Danny Romero. Danny, what are we making of these latest figures today?
So like you said, sales of newly built homes did get that bounce in February, really signaling to the market that it's going to be gaining back its footing. So if we take a look at that data that we got out this morning, regionally, the West had the most new homes sold. And compare that to the Northeast, it really took a hit. It's down 40%. The South is still doing well. And to put it into perspective, if we look at the West, for example, San Francisco, home prices, home values have drastically fallen there due to the fact that the pandemic really caused this massive exodus of residents to leave that area. But not only that, tech layoffs have also impacted that region as well. But another part of this story, if we look at the report as well, is the fact that inventory levels for new homes has also is still down. It's down about 1.2%. In that same report, the number of homes sold and are about to start construction rose to the highest level. And to give you some insight on the home builder perspective, last week we heard from the home builder company Lennar. They said that they are betting on the fact that there has been a drop in housing starts and building permits. And because of that, they say that there's going to be more availability for labor and materials, which will allow them to really increase the pace for their new homes. So that's just kind of give you a little bit of perspective on the home builder side. But another thing too, under this whole backdrop, mortgage rates have also been on the downswing.
Yes.
Really fueling, home buying activity, which we've obviously seen even under these current banking fallouts.
Yeah, so it's great. Mortgage rates are coming down, but at the end of the day, it comes to confidence in the banking system. Confidence runs both ways. As a lender, as a bank, you want to have confidence in the ability to make those funds available. And then as the lendee, the person who's borrowing the funds, you need a bank to be able to do that. I'm just wondering, how has the recent bank turmoil kind of influenced the housing market?
Well, buyers are still confident, even under the current circumstances that we are dealing with in the banking sector. KB Home said in their earnings call yesterday that they said buyers are still confident and they haven't seen any changes when it comes to tighter lending rules or even changes to their underwriting when it comes to their home loans. But another perspective for home buyers is that they're still dealing with impacts. I mean, they're putting down less for a down payment because of these higher costs. Mortgage rates are still double than what they were during the pandemic frenzy that we saw, right? So costs are still high for home buyers. And so that is also into the mix of everything that is going on, especially now with the whole banking sector, the turmoil there.
Yeah, a couple of surprises there. Really appreciate that report, Danny Romero. And moving on, Ford discloses the $3 billion that it lost due to its electric vehicle business. The automaker walked investors and analysts through how it's currently organized and operating. And here with all the details is Yahoo Finance's Praz Subramanian. Praz, there's a big investor day over at the New York Stock Exchange. Just wondering how this is going with their plan. They're basically segmenting their operations, which makes a lot of sense. Different materials, completely different procedures to deal with ICE engines as opposed to the EV models. What's going on?
Yeah, Jared, a big day today for them. They, like I said, reorganizing the business. They call it a refounding there. So basically what they're doing is separating the main core business into three parts. Ford Blue for their traditional gas-powered cars, Ford Model E for electric, and Ford Pro for commercial applications. So, basically most automakers divide their sort of sales kind of performance by region. In this case, everything's going into one pot, right? So for Ford Blue, that's ICE-powered cars across the entire world, right? So basically what they're saying is that they're going to do that as a way to show, kind of give transparency into how the business is transforming. But like you mentioned there, what's kind of catching people's eye there is that the fact that they anticipate a $3 billion adjusted EBIT loss for the EV business this year.
Yes.
Now we knew that was going to happen, but it's kind of, when you see that number kind of popping out at you on a spreadsheet, it's a little bit, what's going to happen next? So good thing for Ford is that they expect that they not only did they reiterate their profit guidance for the year, but they said that by 2026 they expect the EV business to be kind of have easily break even, but also have an 8% profit margin. So that's what they're hoping to get by that point. So they see the future, they see where the business is transforming, they see how they're going to actually make this a profitable business. And they talk about how, the numbers of how you if I sell an EV in my commercial division, how does everything flow? So there's a whole process for that too.
Right, and I think that's kind of the tricky part. I'm just wondering if you could get into the accounting a little bit without getting too wonky, and then maybe compare it to Tesla, because Tesla, they're just a pure EV play. They got this advantage. The way I see it, is it an advantage? Just talk about the economy.
Tesla at this point is, because of the fact they've already put that investment into their business years ago, they're recouping those upfront costs, and now they're actually very, very, very high from an automotive gross margin point of view, minting pretty good profit. But like you said, for Ford now, because they have the traditional ICE business and the gas business, so for instance, the Ford Lightning electric vehicle is built at a Ford Blue plant, which is their gas power business. So if Ford Model E sells that car, they have to basically pay the cost of that to Ford Blue's division, and Ford Blue actually will have a markup on that as a sort of a added on service that they're providing. So it all evens out, but in the end, it gives the profit. A lot of the costs are sort of associated with the Ford Blue division, but the profit and revenue comes in the Ford Model E. So it all works out, but it just kind of shows you how the business operate. But you wouldn't have that if you have a Tesla business.
Yeah, that was kind of my point, but really interesting stuff there, and appreciate those insights. Prod Supermanian. Coming up, we are back at Capitol Hill for the latest surrounding the TikTok hearing. Stick around. Many economists had believed that elevated inflation would be transitory or short-lived, since it stemmed in part from COVID-related supply chain snafus. But it's been 2 years since inflation started to rise above the Federal Reserve's target of 2%, leaving the street wondering if there's still a case for transitory inflation. Yahoo Finance's Rick Newman joins us now for more. Rick, can we finally consign this word to the dustbin of history, or might it be repurposed?
No, maybe it can be repurposed. An interesting paper by two economists, well-known economists, Robin Brooks and Peter Orszag, caught my eye recently. They actually think that supply chain disruptions relating to COVID are still pushing up prices. And the reason they think this in this paper they recently published, they looked at input prices and output prices for manufacturers at the end of 2022. and they found that input prices, what they pay for raw materials and components and things like that, they were back down to pre-COVID levels. But output prices, what they charge wholesalers and retailers, were not. They were still elevated. And based on the numbers these two economists found, they thought that supply chain disruptions dating back to COVID could have accounted for between 30% and 70% of core inflation at the end of 22. Jared, that's a lot. I think we know that supply chains are basically back to normal. And I think that because they are, most people think, well, that means that must not be a factor influencing inflation anymore. But what these two economists are saying is there's a lag. And the lag could be much longer than anybody thinks. We don't have a lot of historical data on this. And maybe it's taking quite a while for prices to normalize, which would actually be good news for inflation because it would suggest that it may abate on its own more than a lot of people think. And perhaps the Fed could stop hiking rates or maybe has even overdone it. So, nobody knows for sure what is really causing inflation and how to get it down. But this is a different way of looking at it.
Yeah, really appreciate insights there. Got to leave it there. Rick Newman. TikTok CEO Shou Chew clashed earlier with committee chair Kathy McMorris Rogers when asked about the app spying on U.S. users. Let's take a listen.
TikTok spied on American journalists. Can you say with 100% certainty that neither ByteDance nor TikTok employees can target other Americans with similar surveillance techniques?
Chair Rogers, I first of all disagree with the characterization that is spying. It was an internal investigation.
Yes or no? Can you do surveillance of other Americans?
We will protect the U.S. user data and fire it all from all unwanted foreign access. It's a commitment that we've given to the committee.
So I guess my question is, I wanted to hear you say with 100% certainty that neither ByteDance nor TikTok employees can target other Americans with similar surveillance techniques as you did with the journalist.
Again, I don't disagree with the characterization is surveillance, and we have given our commitments, Chair Rogers. The 4 commitments, I think it's our commitment that we will not be influenced by any government.
Rochelle Akufo is at the Capitol now where that hearing is ongoing. Rochelle, I've noticed people sitting in that chair over the years, they don't like to answer in yes or no, even if they're prompted. But what's the latest? What's going on down there?
I mean, as you mentioned there, obviously trying to get him cornered into these yes or no answers, trying to get something like, can you be 100% sure of some of these accusations that are being levied against him? Some of the responses, I'll get back to you. Some of them, obviously, he wanted to expound on the answers. Lawmakers really not giving him much wiggle room. One of the ongoing themes we continue to hear throughout today's testimony is this issue of ByteDance's ownership and TikTok's ownership. How much of a role ByteDance has had in the testimony today in preparation for it, as well as the ownership structure. So I want to toss to the soundbite here regarding the Chinese government and how he laid it out in his testimony this morning.
ByteDance is not owned or controlled by the Chinese government. It's a private company. 60% of the company is owned by global institutional investors. 20% is owned by the founder, and 20% owned by employees around the world. ByteDance has 5 board members. 3 of them are American.
But it was still a very, very hard sell for lawmakers. They still kept honing in on what happens to this data, where is it going, and if they were being compelled by the Chinese government, would they be able to say no? A lot of lawmakers saying China seems to think it would be able to compel TikTok to turn over US data. I also want to get to another powerful part of the testimony today, because obviously the full name of this hearing today, how Congress can safeguard American data privacy and protect children from online harms. And I will say Representative Bill Rackus talked about TikTok challenges and actually played a very disturbing video showing some of the feed that came up for 16-year-old Chase, who was a teen from New York who committed suicide by stepping in front of a train. And they showed a clip of some of the images and the videos that he was looking at. And the representative really wanted Shou Chew to talk about the algorithms and whether he would take full responsibility for them and prioritizing this sort of content, which he said, we don't promote harmful content. Some of it might be inherently unharmful. For example, he gave the example of someone looking for videos about running 100 miles, which in itself isn't inherently harmful, but if the wrong person looks at it, if it's someone who perhaps is predispositioned to a condition that may make them exercise more or feel bad about their physical appearance, that yes, it could lead down that road. But you could definitely tell lawmakers really not happy with a lot of the answers they're getting and really wanting more certainty at this point as well, Jared.
All right, really appreciate that, and we're going to keep you down there and check in with you later in the day. A ban or sale of TikTok would have serious impacts for other social media companies. Joining us now for more is Rocco Strauss, partner, senior analyst at Arete Research. And Rocco, thank you for joining us here today. There are some obvious potential winners from a TikTok ban, but could you go over some of the details, which are a little bit murky, exactly how this potential ban would benefit some of the existing competitors?
Yeah, sure. I mean, it really at the end depends on if we actually get a ban or a divestment, right? So like a ban obviously would have clear benefits to all of the larger ad-funded internet names. So we're talking Snap, Hinge, Meta, and certainly also Google or YouTube. I mean, in our view, Meta stands best, with Instagram to capture, give or take 40% of the time spent in case of a ban. And if that translates into a similar 40% share of the $15 billion, give or take, that TikTok is expected to deliver this year in advertising revenues, you're talking about like $6 billion of additional revenues. Where it becomes more interesting is with respect to Snap and what they do around Spotlight, so their TikTok peer. If they would capture some, like, say, 15 to 20% of the time spent, which with respect to kind of like the age groups on both platforms, would make sense. And you capture like a similar share of the $15 billion of revenues. You're talking about like some $2 billion on a revenue run rate base that could move over to Snap. And that would kind of like mean a 50% push to top line revenue growth. So there is more material in terms of a percentage of increase. I would also flag YouTube and especially YouTube Shorts, where we think that they could capture like a bit more than Snapchat would. That's generally based on like YouTube Shorts and TikTok being a similar age group. So TikTok is somewhat 5 years older on average per user than Snap is, which means also Google and YouTube should actually capture a bit more than Snap is.
And if there's a divestiture, or let's say there's an IPO for TikTok down the line, they're able to shed all their ties with the CCP, the Communist Chinese Party. What does that has some different implications for their competitors, Snap, Instagram, et cetera, than an outright ban, because suddenly you're talking about the pie is still there. You're not carving up the TikTok users and sending them to other platforms. You're just talking about a change in structure of the company. I'm just wondering how that affects your calculations there.
Yeah, I mean, I think an IPO is somewhat tricky. Because what you would need is proper management that can maneuver open markets. You would need proper infrastructure that can actually both hold the US or like the non-Chinese user data, as well as the algorithms that have to be moved. You need proper R&D and you need proper ad operations. So that in an IPO, in a very short time frame that they may get for that is somewhat tricky. So I think an acquisition or a divestiture and an acquisition by potentially someone like Amazon or Microsoft, right? You may remember back in 2020 when the government tried to engineer a deal between Walmart, Oracle, and Microsoft. Something like that looks more likely. And if it really ends up, as a part of Amazon or Microsoft, which, both have obviously their cloud offerings to host the data and have tons of R&D teams that they could employ here, then you somewhat get a much stronger TikTok, also based on the additional data that you would get, like on the transaction side for Amazon, or from the wider offerings that Microsoft has in their universe, than TikTok is today. And that certainly would not be a positive to any of the larger ad-funded internet names. But what I would also add here, if from an antitrust perspective, a deal like this would be waved through by government, there may also be a short-term time frame, also for Snap to be acquired, either again by Microsoft or Amazon. And for that type of deal, you would create a similar strong Snapchat, as TikTok is as of today, based on the same rationale that we went through for TikTok becoming stronger.
Well, that's really interesting. What happens then if some of these companies, let's say a TikTok or even a Snap, is folded into one of the tech giants here with their nearly unlimited R&D budgets? Contrast that to Facebook, Meta, which is really downsizing. Mark Zuckerberg really turning the screws on its organization and cost cutting. How do they compete in this world where you potentially have TikTok and or Snap overtaken by one of these competing tech behemoths?
Yeah, I mean, I guess the main benefit comes from the additional data source, right? I mean, Meta, as well as Alphabet with Google and YouTube, they have vast ways of collecting data on platform as well as like off platform with all the conversion tags that they have around the web. That is something that Snap, TikTok, also Pinterest is not having as of right now. If you have these additional data assets, you immediately monetize these platforms significantly better, given that you move closer to conversions and have more intent data present, and that brings pricing up, that attracts more advertisers to the platforms, and with that, I think the consideration of like the cost that you would have against that becomes less meaningful.
Quite interesting. We got to leave it there, though. Rocco Strauss, partner senior analyst at Arete Research. Thank you for the time today. All right, let's check in on today's trending tickers here. And first, we're going to start with Block. Shares are plunging after a Hindenburg research report had dropped on the market, accusing the company basically of inflating user metrics and avoiding regulation. Hindenburg, they took direct aim at Block co-founder Jack Dorsey, saying he and the platform, they take advantage of demographics, though they claims to be helping. We will continue, by the way, our coverage of the TikTok hearing all day long. Rochelle Akufo is on the ground on Capitol Hill, and she'll be speaking with Representative Ken Buck later, and you won't want to miss that. All right, time now for a final check of the markets, and we can see the Dow is up over 400 points, still over 1%, S&P 500 up over 1.5%, Nasdaq up about 2.25%. And let's check in on the bond market here. We could go to the Wi-Fi Interactive for that. We're seeing most of the yields down today. And here's a 10-year T-note yield that is down 3 basis points to 3.47%. Also taking a look at the 5-year, that's down a little bit more, 9 basis points. And let's check in on the 13-week T-bill. That is a very short end of the curve. That is down 5 basis points. And just taking a look at some of the sector action today and in the market, well, let's start with the Nasdaq because we're seeing a lot of green there. Microsoft up over 3%, Meta up over 3%, so is Nvidia, Apple, Alphabet, Tesla, Amazon, each up 1-2%. So seeing some nice gains in the tech trade. Let's take a look at semiconductors and contrast that with our software heat map. Lots of green on the screen there. That's all for now. I'm Jared Blickery.